Of course, these days, but they are saying that they are considering selling their stake in East Spring. They may seek to sell about 30% of that particular holding, Guy.
Okay, here we go. Time for the European market open. As we count you down into that opening trade, let's talk about where we are expected to go. The FTSE 100 expected to go a little bit soft. It was up yesterday. The CAC was up yesterday. The DAX was down yesterday. FTSE 100 straight out of the gate, down by a little bit, but not by a great deal. We're down by 0.2%. I'm fascinated to see how the miners trade through this story around China. Keep an eye on some of the technology stocks as well. That's going to be interesting in the wake of what we've seen with Oracle overnight. That may ripple into names like SAP, which has got its own news as well to factor in this morning. So we will watch what is happening. The DAX is just beginning to open up. The CAC is down by 0.2% of 1%. So a mildly softer story. Now remember, the FTSE and the CAC were actually up quite nicely yesterday. I don't think there's a significant reversal here. Maybe just kind of a pause, a wait, a watch. We'll see what CPI delivers.
Yeah, maybe not on the kind of index level, but you are seeing a little bit of reversal in LVMH shares specifically. When you look at your index contribution or your breakdown here, it is your biggest index contribution. I'm going to try to get my words right this morning. That is where you're seeing a lot of the pain. You are seeing it in German stocks. You are seeing it in certain French stocks. That's the underperformer. But your sensational six, your core six, you're the ones that you love to pay attention to, that's driving the upside, but perhaps not enough, Anna, to shake this index.
Yes, and when we were asking questions about whether the good news out of China was priced into European stocks, I think the answer is yes, because basic resource stocks, despite an uptick in iron ore that you flagged, Guy, down by 1.2%. So yesterday we moved a lot on that story, didn't we? And maybe we're done with that. But it does look more defensive today, certainly with healthcare, the best performing sector that has a slightly more defensive nature to it than for a trading day.
Yeah, and of course, and as we break down what's actually moving this, we should give a little bit of love to Stellantis here as well. We're getting a red headline crossing the Bloomberg terminal that Stellantis and CATL will invest up to 4.1 billion euros in the EU battery venture. This also comes at a time when we're talking about Stellantis trying to kind of perhaps in negotiations with Giorgia Meloni's government. We know there's new leadership there as well. They're still dealing with a little bit of the EV story, so that's going to be certainly
you want to kick the EV story into high gear. You've got to do a number of things, one of which is stimulate demand, maybe provide some sort of charging infrastructure, critical as well. You also need the batteries, and that is where Europe continues to struggle. We've seen what's happening with Northvolt.
Yes, I was just looking for a bit more detail on this. So Stellantis and Chinese and CATL, that business, they're planning to invest as much as 4.1 billion in a new plant in Spain. There we go. That was the bit I was looking for.
But this is getting people to invest in Europe.
Yes.
Because Europe is going to struggle to provide its own batteries by the looks of things. A lot of these batteries are going to come from Asia, from China. Are they going to get manufactured in Europe, though? That's what Europe really
and the
wants.
Northvolt story, as you mentioned, really giving us pause for thought about Europe's ability to deliver on that particular story. But we'll watch this one.
Everyone's certainly scared about that. But I should just mention the price is down about 0.5%, so not seeing maybe a ton of love for the stock, despite this, this perhaps of a positive move.
Meanwhile, we are at the Women, Money and Power event. People are starting to gather for it. Background music is amping up. I'm not sure if anybody else heard the music. We heard the music at the top of the hour.
That was the music for the market open.
Ah, okay, excellent. Well, I'm very pleased about that.
It's not just in our heads. Either that or they're playing music for us.
I'm hearing 5 things in my head this morning.
I'm ready for the dance party. Maybe they were bringing a little bit of music to introduce our guest. Joining us now around the table, Ann Walsh, CIO of Guggenheim Partners. And a pleasure to have you on this program. Look, let's talk about these stock markets to begin with. The ongoing debate around this table between us three has always been, are stocks overpriced? Is this something you want to get yourself exposed to in 2025? Or is this something where maybe the party's a little bit over, where the music has died down, for lack of a better term?
Well, certainly in the U.S., what we've seen is post-election, we saw, I think, a pull forward of quite a bit of performance expectation. And a number of things are driving that. Expectations around deregulation, expectations around the continuation of the Trump tax cuts, and all those were positives. But at the same time, it does seem that we also have to remember that there's earnings, and I think we are priced to perfection, and the risk premium is as low as I think I've ever seen it.
Yeah.
And so as a result, I think that there is some risk here, but I think that stocks in general will continue to perform because I think as these policy elements play out, that's probably positive for risk assets generally.
So risk assets in, say, you talked about the United States, let's talk about Europe for a second. What do you need to see to be more optimistic about Europe at a time when I feel like we've been talking about this for years, where Europe is underperforming, dealing with infrastructure issues, not very much doesn't have very deep capital markets. What do you need to see from Europe to say, I want exposure to that?
Well, on a fundamental basis, quite clearly, Europe has struggled, and I think will continue to do so. Frankly, the geopolitical risks, which really in previously stable governments weren't expected. We're seeing it obviously in Europe with France. We're seeing it in Asia with South Korea. These are elements that are added into the level of risk that we weren't really pricing in addition to the fact that we still have weakness in manufacturing, and we still have an economy, particularly in Germany, where we're still seeing recession pressures. Given all of that, the fundamental story is not nearly as strong. Now, if I'm a fixed income investor, I'm still seeing the fact that yields are going to continue, in our view, to drop in Europe. And as a fixed income investor, I think that the spread between U.S. Treasuries and, for example, German bonds is going to continue to be wide, giving a little bit more opportunity in the short run, at least, to Europe in that place.
Yeah, mindful of that spread, then, Anne, are you looking for more support from the central banks in Europe, from the ECB in particular? We're looking ahead to that later on this week, and there's expectation of 25 basis points, not wanting to signal panic. Should there be a little bit more urgency, if not panic, around what we get from the ECB?
Well, relative to history, central banks want to go slow and thoughtfully. There's still a risk of inflationary pressures. The worst case in Europe would be some sort of a stagflation. I'm not calling for that, but at the same time, they want to be thoughtful about that risk. So I still see 25 basis points. Whether they should go more to stimulate the economy, I think there's an argument, but I think 25 basis points is probably what's going to happen.
Yeah, I mean, thinking more globally, we were talking to Gina Martin-Adams from Bloomberg Intelligence earlier on today, and she was saying when you look at what's priced into stocks over in the United States, shall we go for a moment, she was saying that those valuations, they're assuming quite a lot of pricing power from US corporates, a lot of inflation, and maybe we don't get that good kind of inflation, maybe we get the bad kind of inflation that's driven by supply shocks and the like. Are you concerned about the resurgence of inflation then in the US?
I think globally we are in a reflationary backdrop. There's a lot of economic movement, the reshoring to the U.S., the cost of digital build-out, power build-out, any of this kind of investment that's having to happen, infrastructure, you name it, that creates some pricing pressure. Small amounts of inflation, say 3 to 4% in that reflationary world, is not a bad thing as long as you have growth and productivity to go along with it. And the challenge is whether we're going to get that. And I tend to be a little bit more optimistic in the long run, particularly with the technology investment and productivity that will come along with that. But I think it's going to take a little bit of time to play out. The concern is short-run inflation. Now, I still believe that the Fed will actually be effective in bringing down inflation a little bit more. Obviously, we have CPI and PPI this week. And nothing moves in straight lines. We could see some parts of the inflationary story continue to be on that downward trajectory, which is what we expect, but against this reflationary backdrop. So there's a lot of pressure on central banks to be thoughtful with regard to policy.
Great to see you, Anne. Let's talk about which consensus trades in the market do you have the biggest issues with?
The consensus trades I have the biggest issues with?
What do you think is wrong right now? What do you think the market is most certain on that could not happen?
Well, I do think in terms of equities, this huge amount of positive bull market sentiment is always a risk. When you see this consensus trade be so large, Where I think what's probably more at risk is the level of earnings potential. Not necessarily that we're going to have good earnings, but that we're going to have those good earnings.
Yeah.
And I think that that's a risk. This pricing to perfection, if there's anything that could happen, it will put pressure on the markets. The other element, I think, is that we're going to see interest rates either go way higher or way lower.
Which one is it?
Exactly. It's neither. Our view
Right.
is that we're trading in a range in the U.S., particularly in the 10-year,
Yeah.
so really between 3.5 and 4.5, and we're going to stay here. Now, it's an actionable trade. You can extend duration when rates go up to 4.5. You can
Yeah.
shorten duration when they go down. And I think that is out of consensus right now. And I think that's really the pattern. We've been in that pattern for 2 years.
Yep.
With the Fed coming down in rates, that's taken the top off of it. I don't see 5%. So 4.5 to 3.5, really.
Is Trump going to be good or bad for equity markets?
I think what we're going to see is we're going to see a play, if you will, a game of badminton between politics and policy over the next couple of years.
Okay.
And I think policy, at least at the outset, sounds for the most part pretty good,
Yep.
with the exception of the question of tariffs. I think tariffs are still more of a negotiating gambit than they are necessarily where we're going to see across the board tariffs everywhere. I think they're going to be more targeted. I do see tariffs, but I think
Yeah.
they're going to be targeted.
I've never heard Marcus described as a game of badminton. That's fantastic.
Not tennis.
No.
Badminton. Yeah. I'm trying to work out what's the difference in my head, but I'm sure it's
A little bit more air
Yeah, a little
involved,
bit
I
more
think.
time involved.
carefully crafted metaphor. We like that.
You talk about this reflationary backdrop, though, and when we've seen the first Trump administration as perhaps an initial playbook of that impact on tariffs, et cetera, in this iteration, if we do see that reflationary backdrop, where is the burden placed? Is it on commodity costs, supply chains, corporations, or is it on consumers and a U.S. consumer and hitting savings? Who bears the brunt of that, and how do you trade it?
It's a really interesting question. I think if we see targeted tariffs, as I expect, more associated with, well, I can say China will see some tariffs. I do believe that. But Europe or other countries, it may be more about how other countries can affect or help the Trump administration with policy, whether it's reducing the drug trade through Mexico or, or EVs or something more specific. And of course, also, digital cyber security, any number of those kinds of things. Then I think that probably corporations bear more of those targeted costs relative to consumers. If, however, we see more broad-based tariffs, I think then the consumer could definitely be impacted.
We were talking also with Gina a little earlier on about AI and whether this was a big enough structural trend that sort of compensated for maybe some of the other downsides that we're thinking about in the economy right now. And she was saying what's key right now with AI and that theme is whether it spreads from where it is right now with the superscalers and with a lot of the hard tech names, and when it starts to really spread into the rest of the economy. We talk to lots of CEOs who tell us, well, we've been using AI for 10 years, and that makes you think, well, maybe is it such a big deal then? So what are you expecting this to deliver then, Anne, when it comes to the global economy?
So I think we're in really, really early innings of the artificial intelligence and technology boom that we're going to see. I'm very optimistic in the long run for the impact on productivity. Right now, we're just sort of building out the framework and the infrastructure to support that technology that's going to really take us into the future. So in truth, I think that we have a long way to go, and the productivity improvement will be huge. In certain industries in particular, for example, healthcare, we're going to see amazing innovations as a result of artificial intelligence. We haven't even begun to see yet. And so I think that if you take a very long view, we've got a great outlook for the benefits of AI.
You could have said the same thing about the internet. We'll figure out. It's going to be amazing. Just don't know who's going to be the winner yet.
Right.
There's a lot of money piling in right now. How much of that money is going in blind, and how much of that money is going in a focused way, do you think? Does there need to be a winnowing process? Do we need to kind of figure out what's working, what's not working, and when does that happen?
Well, again, I think right now the build-out is in infrastructure. And we're very positive on digital build-out and data centers and
Right.
other kind of investable ideas in the actual framework to support the technology. But with regard to the individual companies right now that everybody's playing in terms of artificial intelligence, we actually even haven't seen the companies that will actually come to market at some point in time that will really drive the technology implementation and usage.
And that's where the real value is going to be, is it?
Exactly.
So it's not going to be in NVIDIA, it's going to be in some company that we haven't figured out yet.
I think that's right. And I think that right now NVIDIA is great because there's a lot of build out that still has yet to occur. But there will be other companies that actually have applications of artificial intelligence and robotics and all the other platforms that we're going to see that haven't even been.
You don't have a little idea in your mind as to what those companies are? Because that feels like you want to get in at the ground floor.
I'd love to. And I think sitting in private equity right now.
Okay.
Are there capacity constraints involved with that, for example? I mean, you're talking about this ripple effect, but things like the grids, for example, we talk about in the States, we certainly talk about it here in Europe. And that seems to be, you brought up private equity, that's where the juiciest deals are, right? These infrastructure fallouts. But the pushback that you get from that is that capacity where you want to invest doesn't exist, especially in Europe. What kind of time frame are we looking at to actually identify those? Is this a 10-year-long or beyond project?
Well, when looking into my crystal ball, it's a little bit challenging to define a timeline. But what I would say is that if we look at the internet as an example, it was decades long. I mean, when we started in the 80s, we were dealing with barely some spreadsheet technology, and then into the future we developed that. Now we're going to take those spreadsheets and we're going to turn them into artificial intelligence solutions. And so it's going to be a multiplier effect, but it's going to also play out for a long time. And the technology will improve upon itself as well. So I don't see this as being a slow, and short process. I see this as being a very well developed but timely and timeline long process.
And it's super early for us. It's super early for you. Thank you so much for stopping by to see us this morning. We really appreciate it.
Absolutely my pleasure. Thank you so much.
Thanks so much for joining us. Anne Walsh, CIO of Guggenheim Partners. Let's talk about where we are with these markets this morning. Let's take a look at the core six and figure out what is happening at the center of gravity here in Europe. We've already indicated that we are seeing some weakness coming through in terms of some of the luxury names, and you can certainly see that in LVMH. LVMH was up quite strongly yesterday on the China stimulus story. We're giving some of that back this morning. It's interesting that Ferrari is fairly flat this morning, the auto sector in focus, but more with the Stellantis story. Nestle's a little soft. Novo is coming back. It does, as Anna said a little bit earlier on, feel like a more defensive maybe market this morning.
Yeah, a little bit. We are live at the Women, Money and Power event. We keep saying that, and it's worth keeping mentioning because we're on the road. Very excited to be here. You can keep across all of the news flow that's coming through from this event. There's a live blog on the Bloomberg Terminal, of course. You can find that on TLIV Go. And I'm going to be hosting for the digital audience. I'm going to be hosting an event, a Q&A session with some of our fantastic reporters who are here. We talked a lot about M&A, so Ruth David's going to join us on that Q&A panel a little bit later on. We've had a lot of news from the finance sector, obviously, because that's what this event is all about, and so Jenny Surain is going to join in that Q&A a little bit later on. We're also going to talk about crypto, and there's a bit of a future of finance element to it as well, and what the Trump administration means for the crypto space. So plenty to come when it comes to that Q&A. A little bit later on, live here from the City of London. Coming up on this programme, though, the UK and the EU are set to hold formal talks on resetting ties from next year. This, as Chancellor Rachel Reeves says, Britain wants to deepen its relationship with the bloc. More on that next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade. We are live from Women, Money and Power. We are 20 minutes into the session. European equities look a little soft this morning. You've got healthcare stocks up and you've got mining stocks lower. That's the general trend, but you need more specifics, don't you? Let's get some more specifics on what's happening in this market with Lizzie Burton.
Well, Guy, I hate to be the bearer of bad news, but let's start with Ashtead. We had that red head crossing the terminal earlier in the programme. Ashtead looking at moving its listing over to the US, and already that knocking the FTSE this morning. Those shares down 7.5% now, about 8% earlier in the session, also cutting its guidance this morning. So a blow to the FTSE, but flipping over, more bad news. Delivery Hero shares also down. They had been down 10%, still about that now. This is as Talabat, its Middle Eastern unit, has actually turned negative in its trading debut in Dubai. This is one of the biggest IPOs in the Middle East of 2024, but not getting off to a good start, and that transmitting over to Delivery Hero as well. More bad news if we flip over to Allianz. It's raised its medium-term profit target. The CEO vowing to put more money back in the pockets of shareholders. This has been his strategy to try and lift the share price, but it's not enough to impress this morning. And likewise, if we flip over to Prudential, they've been reportedly mulling a bit of M&A, looking at a partial sale of Eastspring investments so that they can fund moves into areas like private credit, and that not impressing investors this morning as well. Finally, let's flip over to even more bad news. We've got the luxury stocks that we've been keeping an eye on, all in the red this morning, because that Beijing boost, it would appear, has already been priced in. Anna.
Lizzie, thank you very much. Lizzie Burden there with some of those stocks that are on the move in what is a little bit of an underwhelming market for this European session. US futures as well pointing a little bit lower. Let's get to some of the European politics, though, that we need to keep across this morning. The UK and European Union are set to start formal talks on resetting ties from next year. Britain's Chancellor of the Exchequer, Rachel Reeves, says she wants to deepen the economic relationship with the bloc to boost growth.
I did not come here today to start a negotiation or to lay down a set of demands. Those conversations about the reset and those negotiations will begin in the new year. But what I was aiming to do today was to begin to rebuild those bonds of trust that have been fractured.
So they're the Chancellor of the Exchequer speaking at that European Union meeting. Let's bring in Bloomberg's Oliver Crook, who's also there for us in Brussels. What more do we know then about the nature of these talks? When the Labour government came to power, Ollie, they were making some fairly limited commitments about how they wanted to deepen this relationship, but going around the world and trying to find untapped areas of mutual trade benefit seems to be one of the strategies they're employing right now.
Yeah, and I think that is really what Rachel Reeves wanted to emphasize, really trying to make progress, particularly on the issue of trade and trying to boost those trade volumes between the UK and the EU, which obviously have diminished greatly since Brexit and all the other red tape and things that have been installed. As a consequence, there also seems to be some space for commitments on defense and maybe joint action there. And of course, hoping that the challenges of Europe with the slowest economy and competitiveness will drive the UK and Europe together. However, what I will say is that for the journalists who are really hoping from something for the UK Chancellor of the Exchequer, the first one to attend such a meeting since Brexit, it was much more signal than it was of any kind of substance. Whenever we tried to drill down and get a couple of questions to her, where are we actually going to see some progress? Are we going to see some commitment on defense? Are we going to see some commitment on trade? She was very, very couched on all of that language. You know, having covered Brexit for as long as we all did back in London, you know who she's talking to as well. She's referring to the Tory base as well and doesn't want to be seen giving anything up to Europe. So really the devil will be in the details on any of these agreements. And as far as getting any substance there, that is something that will have to be a project for 2025, if at all.
So, Ollie, let's go from one trade deal or former trade deal to another. Let's talk about the Mercosur deal between the EU and South America. Of course, a big success story from Ursula von der Leyen. Walk us through that reaction.
Yeah, what's really interesting is this kind of got buried on a Friday, and the Mercosur deal is kind of like the Capital Markets Union. It's something we've been talking about for 20 years, and nothing seems to happen, and then suddenly we had the signing of Ursula von der Leyen. This is a huge trade agreement. This covers 780 million people in South America and the EU in terms of the size of the market, and this could really have a significant boost for many of the economies that are suffering here, namely Germany. We spoke to the German finance minister about this. Have a listen to what he had to say.
It is part of this strategy of de-risking from China and diversifying. So from a geopolitical perspective, it would be hugely important to send this signal of cooperation to the Mercosur countries.
So from the German dimension, obviously there's a huge economic boost there. There's a geopolitical also consideration here. If you get tariffs from Trump, if you have bigger markets over in Latin America, this could have a huge impact. However, there is still an ability to block this deal. All it requires is 4 member states, 35% of the European population. If you take France, Italy, Poland, and the Dutch, all of whom have objected to material parts of this, namely on agriculture, it could still get blocked. We'll speak to a few of those finance ministers a little bit later today to see where progress is on that.
Great stuff, Ollie. Thanks for the update.
Crisis. Forged in crisis.
I'm bringing it. Maybe this is Europe's moment to get things done. Crack the whip.
Forged in crisis. Forged in crisis.
I'm bringing the optimism.
Much quoted phrase.
Yes. Okay. We'll watch that one carefully. I'm not holding my breath just yet. Up next, we're going to talk about the rise of private markets. Joan Solitar, global head of private wealth solutions at Blackstone, is going to be joining us. Women, Money and Power is the event we're at. As you can see, the room's beginning to fill up. Plenty more still to come. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. Tuesday morning. Yesterday, the FTSE 100 and the CAC Iran outperformed. They're the underperformers this morning. That's what you're seeing in markets. So you're down by circa 0.5% for those two markets. Other markets around Europe only down a little bit this morning, and we're going to watch carefully to see how we transition, kind of focusing on China to focusing on CPI. I think that probably is how today is likely to work out. Let's talk about private markets and figure out what is happening there. Huge, obviously, momentum this year. We continue to see a lot of money being allocated to this space. Does that continue? How much more can we actually see being allocated to this space? Joan Solitaire, Global Head of Private Wealth Solutions at Blackstone, joins us now around the table. Good morning.
Good morning.
2024 was a year of momentum for your industry. Does it continue next year? How much more can this industry see allocated to it, do you think?
I think it's super early. If you think about the path of travel for institutional investors, 20 years ago, they were allocating 5% to privates. Today, it's 25% for U.S. pension funds and over 50% for foundations and endowments. Individuals are, by and large, under 5%. Almost anywhere you go in the world. So I think we have a very long road upward.
So the opportunity is in the individual rather than the institutional. Is that where the greatest opportunity lies?
Well, my focus is on the individual. Yeah. There's still room, and you're seeing growth on the institutional side, but I think there's tremendous opportunity for individuals and for insurance companies. You're starting to see them allocate more as well.
You've grown this the private wealth solutions business, Joan, into a giant part of the overall Blackstone business. You've done that by partnering in a lot of ways with banks and other parts of the financial services spectrum. I wonder how much more. You clearly think there's much more to go for here. Is it getting more competitive though?
It's certainly more competitive, and I think the positive of that is you have a lot more institutional quality firms now providing funds to individuals. They're out there educating advisors just like we are, but it is so early. It doesn't matter where I travel in the world. I was just in Asia. I've been spending time in Europe, US. Every firm wants to allocate more to privates. They're talking about these as ways to enhance total return, income, provide diversification for stocks and bonds. So I think it's, again, I think it's quite early.
Yeah, so it's quite early. And obviously the private space and the private wealth solutions that you allow individuals to access is quite varied, isn't it? Anything from private equity to hedge funds and the like. Where do you see the most excitement right now. We've talked a bit about private credit this morning with certain guests. We've talked about private equity. We had some news about Apollo trying to raise the biggest ever fund to attract more money into private equity. Where are you most excited about at this point?
So I'd say today we have the most interest in private credit, where you're getting excellent returns for the risk, and that's attractive and a big spread to what you could earn in traditional fixed income or cash. We're also seeing quite a lot of interest in private equity as well, and infrastructure. I'd say the one sector that I think has been a sleeper, but I think in 2025 could see renewed energy, if you will, is real estate. It's been probably the only sector that's lagged, but the sectors we like within real estate bottomed the beginning of the year. Interest rates coming down certainly helps on the valuation side. So I think you'll see momentum build there. But to date, as you mentioned, it's private credit and private equity and infrastructure.
So we keep hearing this conversation that private markets are the place to be, and everyone wants a piece of it. And we were just talking to Ann Walsh as well about the overtaking of these markets from the private space over to the public ones. But how do regular, everyday investors who are so used to being exposed to a stock market get involved with the private markets? It feels like it's something that the ETF market is trying to tackle with varying degrees of success. How do you access it if you're not a large-scale institutional player?
So there are a lot of structures that are now accessible to more people. If you went back in time and you only had the traditional drawdown funds, those you're only allowed to offer those to the uber wealthy based on regulations. But today we have open-ended funds in all of the sectors that I mentioned, and depending on the country, you could access those with a minimum of $10,000 in investments. Some countries it is higher, 200, 250,000, but that's much more accessible than it was where the previous minimums were $5 million.
Where are the cracks then? Give us the juicy stuff, Joan. This all sounds great, but isn't that always the case? And before something falls apart, everything sounds really, really great. We've been covering private markets this all year, really, and every time I speak to someone, whether super return or EPAM, it's always been this enormous optimism around it. But I think we've learned in previous iterations that when everyone is bullish on a sector, maybe that's when you have to start paying attention to the cracks. Are you seeing any cracks at the moment?
I'm really not, and I would say private isn't a sector.
Yeah.
And each of these sectors will be cyclical, right? And so the way to think about it is if you're talking about private equity, it just means these are companies that aren't publicly traded, and they actually account for 90% of the investable universe. And the same in commercial real estate. Yeah. Over 90% of real estate's private. So if you're only accessing the public markets, you're really just fishing in a pretty small pond.
But in the context of some of these deals and these financings having more covenants attached to them, a little bit more complicated in structure as you see more and more people allocate to it, is that a concern? I mean, Jamie Dimon, I keep going back to this because it was such a juicy quote, has compared private credit to the mortgage crisis in the mortgage market prior to the GFC. Is that a fair comparison?
I don't think so at all. First of all, again, it's you go back in time, but those mortgages were held by very levered institutions. They were based on customer deposits. But what is private credit? These are funds, you're matching liquidity terms. These are senior loans. I mean, we're originating private credit loans at less than 40% leverage. That just does not speak to any kind of bubble environment.
Okay, so mood's still good in that particular sector. Joan, whilst we have you here and we are at the Women, Money and Power event here in London, I thought a nice time to reflect on the role of women in financial services. And the reason I thought of asking you is I read something you wrote more than 10 years ago, advice to your daughter in the Harvard Business Review. And you were talking about shouting louder about women's success stories rather than focusing on the things that women can't do. Do you think the conversation has caught up with you on that? Do you think we're better at doing that now?
I do. First of all, I think there has been significant improvement and change, and there's always room for more. But when I started in this business, there really were very few women. And even when I started at Blackstone, the percentage of females in the analyst class was quite small. It's about half now. And my focus has been on sharing success stories and what works, rather than just getting stuck in a negative conversation of what doesn't. We have so many examples of women who are successful in finance.
My advice, by the way, my advice to my daughter is to go to school if she's watching.
If she's watching. What time is it?
That's the first step, isn't it, on the journey? But yes, there we are.
Education. Is there enough momentum? Is the momentum building? How do you see it developing going forward from here? Like in 10 years, Anna took us back 10 years, and 10 years from now, do you see that there is now a big enough base coming through, a strong enough cohort coming through, that relationship is now so embedded in the system that not the hard work has been done, but that it's going to become easier? The pyramid just has a wider base now to build from.
I do think so. So to your point, if you think about the top of the pyramid, we still have progress to be made. If you look at percentage of women CEOs and the like, whether it's Fortune 500 or wherever you are in the world. But if you look at the base, if you look at the middle, even if you look at partner level at firms, just many more women than there were 10 years ago, and that would suggest those women will continue to rise.
So what needs to happen next?
What needs to happen next?
What needs to happen next to make sure that the top of the pyramid is as well populated as the bottom?
Events like this one, maybe.
I agree. I think it's really incumbent upon successful women and men to continue to mentor and sponsor and push people forward who are talented. That's what I try to do day to day. And I see many more female partners, not just at my firm, but at peer firms. And that's real progress.
Yep, and go to school.
Yes, definitely go to school.
Joan, lovely to see you. Thanks for stopping by to see us. We really appreciate it. Thank you so much. Joan Solitar, Global Head of Private Wealth Solutions, joining us from Blackstone.
You got it.
Not sure where that one went. Coming up, we're going to be joined by Lou, Head of Citi Private Bank. We'll discuss how attitudes to investment differ from generation to generation. Baby boomers passing on trillions of dollars of wealth over the next 20 years. Much of that money going to women. That conversation next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much, we want to grow our revenue into our existing cost structure. And there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to the opening trade. We are about, looking at my clock here, 43 minutes into today's session. When you look at these markets, you are seeing red on the screen, but underperformance in France. I think that's the highlight for me this morning. You are seeing the entire market down about, we'll call it 4 to 5/10% down, but the CAC Cameron down about 0.6%, perhaps paring back the move we saw yesterday, perhaps even waiting for that political overhang to kind of disseminate. We are still waiting for Emmanuel Macron's pick for Prime Minister, so we will keep an eye on that. In the meantime, we are here. Opening trade is here at the Women, Money, and Power event at the Pan Pacific Hotel in London. We've got an all-star lineup of females who are, of course, leading the charge in some of these biggest market conversations, not to mention the future of finance as well. Let's bring in one of those special guests. Ida Liu, head of Citi's Private Bank, joins us right here at the table. It's a pleasure to have you. It's
wonderful to be here.
Thank you so much for coming. She, of course, will be on a panel later as well. You can already kind of see the energy in the room ramping up. A little bit of excitement there. Let's talk about these markets, though. 2024 has been a banger year for the stock market, arguably for the bond market as well, seeing a little bit of recovery there. Does this continue? Was the economic resilience of this year a surprise?
Well, I think we can sum up 2024 in 3 words: resilience, divergence, and innovation. So on the resilience side, the U.S. market continues to be very resilient. As you've seen, we're almost at 30% up year to date in the S&P 500. That's off the back of a very strong year last year, 24% return in the market. So lots of resilience, strong corporate earnings still in the U.S., driving a lot of that growth. Then we look at the divergence, because the U.S. markets have really outperformed as compared to the other markets around the world, in some cases by 10 percentage points as it pertains to Japan, in other cases larger gaps of valuation discrepancy between the U.S. and Europe, for example, 20+%. So that's all been driven by innovation. So we've talked a lot about the Magnificent Seven and the contributions that the Magnificent Seven has had in the outperformance in the market. That continues to be the case even this last year with outperformance there. But I think that that's going to be pretty different as we're looking into the year ahead.
In what way, though? Because I almost wonder, every time the bets against, say, the Mag 7 or some of these other very crowded bets, you can look at it in the currency market as well, show up, the people who short that or say, okay, this rally has gone too far, are continuously proven wrong. Why is this time different?
Well, I don't think that we're going to see a stop in the growth of the Mag 7, but what's interesting is the opportunities around the Mag 7. So the 493 other stocks in the S&P 500 that have a lot of room to grow. We're looking at a lot of small and mid-cap opportunities in the growth areas such as tech, in AI and cyber, healthcare, as you look at personalized medicine, telemedicine, and even in clean energy transition, as you're looking at some alternate sources of energy growth in the future, such as nuclear fusion, hydrogen, solar, batteries, and the like. So some very interesting, I would say, industries and opportunities to complement what we've seen with the Mag 7 going forward.
When you talk to clients, when you talk to investors, are they saying, I'm getting worried, I need to hedge my downside? What are they saying, or are they just all in?
No, in fact, it's quite the opposite. I think our investors globally are very bullish on the outlook for the markets and the opportunities ahead. I think the key there is going to be making sure that you have the right geographic diversification in your portfolios. As I alluded to earlier, you're seeing so much discrepancy between performances in different regions around the world. And how do we position our clients properly to capture that global
So effectively, am I buying puts on the S&P and calls on the stock 600 here in Europe? Is that the way I should think about it?
No, not necessarily. I would think of it slightly differently. I would think about positioning towards some of the industries that we just talked about that are ripe for growth and continued growth going forward. And then looking at some of the dynamics that we're seeing right now with the ongoing bifurcation between the US and China as an example. So what does that mean for changing supply chains around the world? What does that mean for economies around the world, such as Southeast Asia, that's benefiting from some of the bifurcation between US and China? Countries like the Philippines, Thailand, Malaysia, Indonesia are really benefiting from that as well, in addition to India. So making sure that you're capturing some of the geographic growth opportunities in investors' portfolios as well.
So it's about geographic opportunities, diversification. What about managing some of the geopolitical uncertainty that you've described there, Ida? And I'm thinking here about the risk of tariffs next year.
Yeah.
Does it feel in any sense that we've priced in a lot of the optimism about next year, but maybe some pockets of the market are complacent about risks? Or is that not what your conversation with clients reflects?
No, it's always about managing the geopolitical aspects and the risks in investors' portfolios. It's number one on clients' minds, is what's going to happen with all of the change of guards. I mean, you all know that we've had over 60 different elections this year, changing of leadership around the world. I know you've covered every single one of them. And changing of the leadership around the world. So there's massive ramifications as you're sitting there as an investor. Think about, okay, it's really important that we have the right diversification, that we have the right growth industries, that we're repositioning towards where we think the growth is going to be going forward. And that's not just with public markets, by the way. It's also with private markets and alternative investments. So we've seen a ever so increasing interest in alternative investments, private equity, direct investing, real estate assets and the like for our clients around the world. And today our clients are about a third in private market and alternative investing, and our family office clients are about 40% of their portfolios in private markets and alternative investing. So quite significant. It continues to be of interest.
So a third or 40% in private markets.
Yes.
That's a really interesting statistic. How to fit that with the generational wealth transfer and the wealth transfer that we're seeing towards women as well, as we're at the Women Power Money and Power event here from Bloomberg in the City of London. You know, we're seeing a lot of this money passed down from one generation to another. We're seeing a lot of money passed to women at this point, both because of inheritance, but also because of women taking more of a role in global economies. Is there a link between that and the private market push? Are there any dots to join there, Ida?
Absolutely. So we are in the midst of the largest wealth transfer in history. 100 trillion of wealth is passing down to next gen and millennials over the next decade. And you're absolutely spot on that women are going to control a greater and greater share of global wealth. Today, women control about a third of global wealth. That number is going to be well over 50% in the next 5 years. So with this changing dynamic, you're also seeing some important and very distinctive changes in the way that they're investing. So women, millennial, next-gen clients, they are behaving and investing slightly differently than what we've seen in the past, with a tilt towards investing with purpose, investing with impact, doing good with their investment dollars, and then also making sure that their legacy is intact. A lot of planning around wealth transfer to their family members and the like as well.
Okay, no doubt some of the themes that will come up at this event, at this conference today. Ida, thank you very much for joining us. Ida Liu, head of Citi Private Bank. Now, from Citi Private Bank to the wider Citigroup firm, Jane Fraser stares down her skeptics. That's the subject of today's Bloomberg Big Take story. You can find that on the Bloomberg website or on the Bloomberg terminal. The Citigroup CEO previously said she needed 5 years to pull off Wall Street's most elusive turnaround. Halfway through that period, she says she's committed to her goals. Fraser spoke exclusively to Bloomberg's Shonali Bassik.
My ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about, we've got the right strategy and vision, we're executing with the right organization, we've got making sure we've got the right talent and culture in the firm, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
If you could give yourself a grade
on the restructuring plan? What would you give yourself?
Oh, we aren't done yet, so I can't give ourselves a grade yet. I've always said that this is a multi-year journey. We're going to be very disciplined about making sure that we don't take shortcuts. And the problem with grading yourself along the way is it becomes too tempting to do a quarter-by-quarter grade, as opposed to we're just very, very focused and accountable for delivering what the end product looks like.
Speaking of the end product, you've set out a goal to bring returns on tangible common equity closer to 11 to 12%.
In the medium term and beyond after.
So Bloomberg consensus this year has Citigroup's return on tangible common equity at 6.8%. What do you say to critics that feel like you're not getting there fast enough?
Oh, we have undertaken a multi-year major transformation of an institution. We are working with ambition, with accountability, and with urgency. So we've already divested all but one of our international consumer franchises and wound down those that we couldn't. We've undertaken a massive reorganization of a company of 240,000 employees in 6 months, such that 50,000 people have a different manager than had 6 months ago. Now, it's been major change. We're being bold. We're ambitious. We're holding ourselves very much to account to deliver on the outcomes we should do. And I say, look at the proof. You know, we're delivering, and we're determined to keep on doing so.
Who? That was Citigroup CEO Jane Fraser there, and there's more analysis from that interview in today's Bloomberg Big Take online. We need to continue this conversation, Guy.
We do. So Shonali's back. She's going to be back throughout the day, which is fantastic. So let's talk about what you're hearing and what the takeaway is from this Women on Money and Power event. In terms of what we can take away from what Jane is doing and what she has done, what are the lessons we can learn from her?
Quite a few. I mean, when it comes to Citigroup, it's a pretty specific story, isn't it? But she is tackling a lot of fronts that are very rapid changes on the forefront of Wall Street. You just talked to Ida Liu. She's going to be on my panel a little later.
Yep.
That's going to be a big panel focused on wealth management, but also where private assets fit into wealth management. Of course, Citigroup made that landmark deal with Apollo. But, you know, I also just want to acknowledge here that this is a conference about the future of finance with women put at the forefront of that story. And why is that? We're talking about this now in this manner because you are seeing so few women in the C-suite, but you're seeing more and more women on boards. And it matters because you are seeing more wealth transferred to the hands of the next generation, which is often women. Whether that be generational wealth passed on through wealthy families or women who are starting more and more to start businesses and therefore look for an IPO. Some of the measures, guys, that are put forward are compromised. You think about it, the NASDAQ board diversity rule, will that make it through 2026 in the next couple of years with the DEI backlash that exists out there? Or, for example, Goldman has a rule. It won't take a company public without 2 diverse directors, one being a woman. And so that has existed, it has pushed the ball forward, but will it more in the future?
All right, you got to pick your favorite. I'm going to put you on the spot. 30 seconds. What panel are you looking forward to the most?
Actually, the next one. Jenny Johnson is kind of a hot topic right now. You know, family really built a mutual fund complex. Can she get into private assets too? We'll see.
All right. Bloomberg Shonali Bassick there, of course, leading some of those conversations she was just telling us about as well. You expect some headlines from key executives today. The Bloomberg Women, Money, and Power event. That is where we are. In addition to the conversation with Jenny Johnson, she was just talking about the lineup includes, of course, more from Citigroup CEO, the head of Man Group, Santander's executive chair, and of course, Jenny Johnson again, the Franklin Templeton CEO, among just some of the names.
Okay, so those are some of the voices that you'll be able to hear from today here at this event. A T-Live, TLIV blog.
My name is Konstantin Stefana. I am the owner of the family office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will publish. I will roll for almost a month your video for all financial community. The channel is live. It's streaming live 5 days a week, from morning to night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Day ahead. The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards, live from Bloomberg's inaugural Women, Money and Power event in London. In for Francine Lacqua this hour, here are your top stories. European stocks slip after China's rally fades, damping earlier enthusiasm about a stimulus boost in the world's second largest economy. Police charge Luigi Mangione with murder for the fatal shooting of United Health executive Brian Thompson, the 26-year-old arrested in Pennsylvania after a 5-day manhunt. Plus, we'll hear more from some of the most influential voices in finance from around the world here at Bloomberg's Women, Money and Power event. Welcome to the program, everybody. Let me tell you that a top live blog, TLIV, a TLIV blog is now running on the Bloomberg terminal. That is open to Bloomberg subscribers, of course. It'll cover everything you need to know about the event. You can check it out on the terminal using that function, TLIV Go. We are also going to be hosting later on a live Q&A about the event with some of the fantastic internal voices who'll be covering the event. We'll have crypto covered, M&A covered, the world of finance from top to bottom covered. That Q&A from 1 p.m. London time, so you can log on to that and ask questions of our panelists. Let's take a look at the European markets map then and show you what we have underway as we are live from this event. We are, of course, bringing you normal service, keeping across the live market environment. And the FTSE 100 down by 0.5%, the Stock 600 down by 0.3%, the CAC 40 down by 0.6%. So a little bit of weakness coming through on some of these markets across Europe. Let's just get to a look at the broader market picture, and we've got US futures that have been pretty negative through this morning, only just actually, and they still are just down 0.1%. So E-minis down 0.1% this morning. The US 10-year yield, you can see on your screen, 4.20 is where we trade. So yields just ticking up a little bit, and we saw that at the start of the European session, a little bit of movement in the bond markets as well. In terms of euro-dollar, you can see on your screen where we are on euro-dollar right now, a little on the back foot, down by 0.2%. We're waiting for the ECB rate decision. That's the big central bank event of the next 24 hours, certainly. And we're waiting for CPI out of the United States. So both of those elements could move euro-dollar, of course. And we'll also keep an eye on commodities. Let us turn our attention to the latest developments out of China. President Xi Jinping says that China has full confidence in achieving its economic growth target this year. His comments come after Beijing's top leaders signaled bolder economic support next year ahead of Donald Trump's return to the White House. For more, let's bring in Bloomberg's Katia Dmitrieva, who's been tracking this story from Asia for us. Katia, let's dive into some of the details then. What does this signal then about Xi's potential approach to the US come next year and potential tariffs? Because yes, we've had these commitments around fiscal policy, monetary policy, but we've also had some commentary from Xi around trade.
Yes, well, Xi and Chinese officials are really trying to bolster the economy here, as well as sentiment ahead of 2025 and what's looking like a very challenging 2025. You know, we're still about a month away from President Donald Trump, Donald Trump becoming president of the U.S. He's promised tariffs on a raft of countries, including China. And so officials really messaging here last night, that they were going to be willing to have more fiscal stimulus and using more monetary stimulus. How the market took that was lower than expected rates and a lot more funding, potentially for households to sort of transition to that consumer-led growth model that a lot of economists have been looking for. Now, we monitor these statements because words are very important. We kind of track Chinese officials like we do the Federal Reserve. So every single word addition or removal or change signals a new direction. And this clearly signaled that officials are willing to use more of these tools to shore up the economy.
Yes, and we saw yesterday, Katia, that was something that was really pushing European stocks higher, that optimism around what China was going to deliver. We've heard a little bit more then from Xi today. It's not having quite the same impact on European stocks, but maybe all priced in yesterday. Xi said that the economy would hit its 5% target this year. Do economists agree with that? How much credibility do they attach to these kinds of statements?
Yeah, they absolutely, so far, they do agree. And now we're kind of at the end of the year, all the forecasts are in. And a Bloomberg survey shows that economists are expecting 4.8% growth, which is exactly in that target range of about 5% that Chinese officials set sort of earlier this year. And so they're looking to hopefully sustain that momentum into next year, but that will be very challenging, not just because of the tariffs and the fact that China has really relied on exports to drive growth this year, but also because of bigger issues, structural issues. The real estate sector still hasn't found bottom. There's still a lot of consumer sentiment that needs to be pulled up, and a range of other issues, including deflation as well. So maybe for 2024, but more of a question for 2025.
Katia, thank you very much. Bloomberg's Katia Dmitrieva with us there with analysis of the China story. So some of it priced in, as we said yesterday during the trading day, or maybe much of it, because Basic Resources went from the real darling of the trading day in Europe yesterday to somewhere near the bottom of the pack. Let's move on to some other corporate news flow that we need to cover. Oracle's quarterly revenue was in line with estimates, but shares are falling more than 8% in pre-market trading. We'll put that latest live price on your screen for you, and it is, yes, in negative territory. Let's bring in Bloomberg's Tom McKenzie, who's been covering the tech story for us from various angles. So Oracle's revenue, Tom, it was in line with estimates, and yet that doesn't seem to be good enough in today's market. Why the pre-market slump?
Yeah, look, this is an element of the earnings story when it comes to AI that you and I have discussed before, which is about expectations. Very, very high expectations, particularly given for a stock that has seen a more than 80% run-up year to date in two previous blowout quarters. This was not a blowout quarter, but do not make any mistake, this doesn't suggest, the earnings from Oracle, that demand for AI is waning substantially. But they just didn't meet the expectations that analysts had. Again, given what has been that outperformance in previous quarters. Revenues increased 9%. The unit that provides the infrastructure around the cloud business, so the data centers part of the story, which is so important when it comes to AI, that actually saw growth of about 52% for the quarter. But there was a little softness in one measure of forward bookings for the business, and also the earnings per share came in a little below the estimates as well. In terms of the guidance for the current quarter, so Q3, there's a little bit of disappointment there as well in terms of the revenues guidance and the profit guidance also missing the estimates. Larry Ellison, the co-founder, of course, of this business, the chair, he's still talking very positively about the AI prospects for Oracle going forward. He talked about a deal that they have with Meta to train some of their AI agents on Oracle's infrastructure. But clearly, this is again a question about whether analysts set their expectations and Oracle's ability to deliver. The stock, as you say, feeling a little pressure so far pre-market.
Okay, and what does so there's some questions then perhaps come out of that about AI demand, and that's something that the market has been very sensitive to, and maybe why we see such movement in the Oracle share price pre-market. But what about what we've heard from other parts of the tech space on that theme, Tom? TSMC's results, for example.
Yeah, so TSMC's numbers, and these are monthly numbers, show that demand is still there. This is a company that provides the servers to those data centers, and the increase in sales for the month of November, 34% for TSMC, again, underscores the demand is still there. They, of course, make the chips as well, the GPUs for NVIDIA, the chips for Apple and others, but increasingly pushing into that AI infrastructure space as well, providing that hardware for the data center. And it suggests that TSMC is still very well positioned. Interestingly, Bloomberg Intelligence suggests that maybe TSMC will have increased pricing power as well, given the challenges that Samsung, its key rivals Samsung and Intel, have faced in terms of developing their own infrastructure service to provide that infrastructure support for this AI revolution. So TSMC is still performing quite well. The stock, by the way, in terms of that company, Taiwan, of course, listed over in Taiwan, up about 80% year to date as well. So it's been a very strong performance, and the numbers today suggest that demand is still there, and TSMC is still well positioned.
Tom, thank you very much. Bloomberg's Tom McKenzie, of course, with all those tech themes, pulling together some of those AI-related stories from Oracle to TSMC. Let us keep you updated with some of the geopolitical developments that we need to cover. The rebel group that toppled President Bashar al-Assad has begun forming a transitional government, according to Syrian television. It's being led by Mohammed al-Bashir, the head of a quasi-government set up in 2017. The move comes after a meeting between al-Bashir, HTS's leader Ahmed al-Sharaa, and current Prime Minister Ghazi al-Jalali. Brazilian President Lula is in intensive care. That's after undergoing emergency brain surgery in Sao Paulo. The hospital says the craniotomy was uneventful and that President Lula is in good health, but he is being monitored. Coming up on the program, we are live at the Women, Money and Power event brought to you by Bloomberg, our inaugural event. Francine Lacroix will be discussing global investing industry trends with Jenny Johnson, President and CEO at Franklin Templeton. We will certainly be sure to miss nothing of the main events taking place at this conference here in London. Women, Money and Power in a few minutes. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
there is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back. This is The Pulse. I'm Anna Edwards, in for Francine Lacroix. We're live from the Women, Money and Power event here in the City of London, brought to you by Bloomberg. We're waiting for things to really kick into gear here, and in the meantime, let's get up to date with another important story this morning. A suspect has been charged with the murder of United Health Group executive Brian Thompson. 26-year-old Luigi Mangione was arrested after a tip-off at a McDonald's restaurant in Pennsylvania. The state's governor, Josh Shapiro, says the suspect should be, quote, no hero to people frustrated with the American health insurance industry.
In a civil society, we are all less safe when ideologues engage in vigilante justice. In some dark corners, this killer is being hailed as a hero. Hear me on this. He is no hero.
For more, let's bring in Bloomberg's Jill Desis, who's been following the story for us. Jill, what do we know about the suspect, then, in this killing?
So, Anna, so far what we have is, the suspect's name, Luigi Mangione. He's 26. Appears he came from a very well-off family in Baltimore, Maryland, and was actually valedictorian of his high school class, went to an Ivy League university, Pennsylvania University. Still getting a lot of details right now, but it appears that when he was ultimately arrested in Pennsylvania, before these murder charges in New York actually came through, he was found with what we're hearing appeared to be some type of a manifesto that kind of rails against the healthcare industry. There's still a lot of speculation about what exactly led this to ultimately happen here. There's been various bits of speculation online as to where his political leanings ultimately led. By sort of trawling through some of his online accounts, we've learned that he actually had followed the manifesto from the Unabomber, Ted Kaczynski, and actually said that even if he disagreed with what Kaczynski had done, he had made some interesting points. So again, some of these sort of political or at least philosophical leanings still kind of coming into play here. There's also a bit of speculation about how much maybe some kind of an injury may have played into some of his feelings and how that may have sort of manifested in the form of this killing. If he did actually commit it. But again, all of that is still kind of coming together here. But really does sort of paint the picture of somebody that came from a very well-off background that's gotten into this kind of situation as we wait for more details here.
Yes, so certainly waiting for more details. As we were just hearing from state voices, no place in civil society for this kind of vigilante action is the view there. But of course, this does seem to have resonated, the underlying motivations, if they are what they seem to be, around an unhappiness with the healthcare system. That discrete point does seem to have resonated with a number of people, Jill.
Yeah, sorry, Anna, you're a bit hard to hear, but I mean, yes, I think that ultimately what you're seeing here in this killing is something that clearly has resonated, with a lot of Americans, certainly, also just sort of around the world a bit here. You've got this killing involving a high-profile executive CEO of United Healthcare Insurance. This is a predominant insurance company in the United States, covers many Americans on insurance, and there's something about about this killing that's really sort of encapsulated a lot of the frustrations that are facing a lot of Americans who are very critical of the American healthcare system, because even when you're putting in these incredibly high premiums toward your insurance coverage, often certain surgeries don't actually go covered. And we've really seen over the past week since this killing took place, a lot of this kind of frustration manifests itself in the form of statements online, people talking about some of their insurance stories, that kind of thing. So it has been really, really interesting to kind of watch this unfold, not just as a story of the murder of this man, but also something that just sort of turned into this broader sort of critical view of the healthcare system. I think it'll be really interesting to watch how that goes forward. Obviously, some details that are still developing here, not just about the suspect, this person of interest involved in this killing, that police are alleging to be involved in this killing, but also what it says about this industry at large.
Jill, thank you very much. Bloomberg's Jill Deesis joining us there with the latest on the hunt for and the seeming charging of that suspect. Let's get to some other corporate news that we need to cover for you. Stellantis and China's CATL are planning to invest as much as 4.1 billion euros to build a new plant in Spain for electric vehicle batteries. The facility could reach a 50 gigawatt-hour capacity, depending on the EV market in Europe, and continued support from Spanish and European Union authorities. Meanwhile, Bloomberg understands Italy is in talks with Stellantis about commitments to protect jobs and support suppliers. This as Chairman John Elkann seeks a new course for the maker of Fiat and Alfa Romeo cars that recently ousted its boss. Shares of the chocolate maker Hershey surged after Bloomberg reported that its biggest or bigger rival, Mondelez, is looking to buy the business. A potential deal would create one of the world's biggest candy companies with combined sales of almost $50 billion. Sources say Mondelez has made a preliminary approach to Hershey, which has a value of more than $44 billion, including debt. China has opened an investigation into NVIDIA after suspicions that the US chipmaker broke anti-monopoly laws around a 2020 deal. Beijing had given approval for the deal 4 years ago on condition that NVIDIA did not discriminate against Chinese companies. The move is being seen as Beijing's latest response to escalating US technology curbs, as a feature of those curbs may be to discriminate against Chinese companies. OpenAI has rolled out its long-awaited Sora AI video generator to paid users of ChatGPT. The tool creates realistic-looking videos up to 20 seconds long using just a few text prompts. Users on cheaper ChatGPT subscriptions will be limited to creating 50 videos a month. The service isn't available in most of Europe, which has tougher tech regulations. Now we are at the Women, Money and Power event. The global investing industry has undergone dramatic shifts in recent years, with firms getting bigger, passive funds catching active ones, and the rise of private capital. Bloomberg's Francine Lacroix will be discussing all of these challenges with Jenny Johnson, President and CEO of Franklin Templeton, here at the Women, Money and Power event. Let's listen in.
Banks really want to preserve their capital for their biggest and best clients, and so it created this opportunity for private credit to step in. I think that, honestly, low interest rates were probably one of the things that fueled private equity, but also a bit of the environment where I think less and less companies want to go public, and I don't think that trend changes. I don't think there's a lot of people going, boy, I'd really like to be a public company CEO these days. And I think in a time where you have all these great technological advances like AI, where companies need to invest in the technology that may not pay off for years, it's really hard with the pressure of quarterly earnings. And so in some cases, transforming a company ends up being better in the structure of private equity. So I think like that trend is here. I think, look, I'm a big fan of blockchain. I think that's going to open up new investment opportunities and kind of interesting things. I always say that eventually your financial advisor is going to report your portfolio in 3 ways. They're going to say, here's your investment return, here's the impact you have, and by the way, here are the loyalty programs that you've gotten from your tokenized equity ownership that have now tied loyalty programs to it. So that's where I think things ultimately evolve.
So on blockchain and Bitcoin, does that change significantly under a Trump administration?
Oh, for sure. And again, I always make sure you separate Bitcoin from blockchain. Okay, so
Fair.
Bitcoin, different deal. You know, I was a skeptic of it initially, but a couple things people said to me. One, somebody who lived in Israel said, my parents and grandparents had their money taken away by the government. They will always keep a portion of their savings in Bitcoin. And then I had actually an employee who lived in the Middle East and said, if I say the wrong thing, I can have my accounts frozen. So I always keep a percentage of my earnings in Bitcoin. And obviously in the kind of key, because they can keep it protected. So if you grow up in a society where you feel your money's safe, you think that doesn't make any sense. And why should this external currency come in? But if you actually think that there's a lot of the world that would like that safety and control, you can see where Bitcoin has a lot of opportunity. And then blockchain, again, it's a technology. It's a technology that's going to do a lot of really good things in financial services. A lot of toll takers take a piece of a transaction. That can eliminate it, and so it's going to create more efficiencies. It's going to open up investment opportunities.
Jenny, do you think that there'll be a catalyst for companies to want to go public again, or is it just private all the way? Is this, you know, the trend for the next 5-10 years?
So I actually think it used to be you go venture, private equity, IPO, public markets. I actually think, so I think that stays, and we see it where people are just waiting a lot longer to go public. But at some point, people want that liquidity and monetize it, and the private markets aren't yet that liquid. There's some amount. But I actually think what you're starting to see is public companies being taken private because we invested in a company, InvestNet, and they have $3 trillion in assets by financial advisor platform, right? They need to invest in it. It is hard as a public company to make those kind of investments and say to the street, hey, by the way, this is going to impact earnings for the next 18 months. So they become private, right? And so they were taken private by Bain Capital, and then they'll go public, I think, again. So I think there's going to be this new cycle of pulling people off, doing the investment that needs to happen, whether it's AI investments or whatever, and then going public again.
But do you have a concern on valuations in private markets? I mean, this comes over and over again, but we haven't really seen anything. Maybe real estate went a bit ugly, but there's nothing huge.
Yeah, I mean, one of the concerns, you know, investment grade and even some non-investment grade of private credit is trading at the same spreads as traditional fixed income. Like, so you get no premium for illiquidity. That worries me. That kind of thing, I think. I mean, fixed income markets are priced for perfection at the moment. So, you know, you always have to pick your spots. We have a huge secondaries business. I think that they've deployed this current fund with about a 26% average discount. There's about 70% deployed. And, you know, what I say is it's not that the valuations are wrong of the private equity. It's that there's not a lot of supply to create liquidity in that market because there's not a lot of secondaries. But that gives you a little bit of a pricing element.
So what does that mean that you'll do for actually Franklin Templeton in terms of risk taking and does that, you know, to take advantage of these new trends, do you change the company at the margins?
Well, we had to, right? So we've done 10 acquisitions in the last 5 years, and those acquisitions have been focused on really capabilities that we didn't have. I mean, our job is to provide our clients with choice across the full risk spectrum, and then deliver it in different vehicles, which are appropriate to whatever the client's looking for. And so we recognize that, look, this alternatives trend isn't going away. You see more and more institutions, and right now we're really nascent as far as the wealth channel, the average person's access to that. But you could see that trend, and you could see the excess returns in there by the better players. I mean, there's a big dispersion in the top performer and the bottom performers in the alternatives. And so we recognize, so today we're a top 10 alternatives manager. So that was, most people think of us as really just traditional, you know, equity and fixed income, but we're actually quite large in the alternatives. So it's, again, about creating choice. We also filled in some other product gaps that we had. And then now it's going to be about delivering those capabilities appropriately to clients. And so if you look at today with the wealth channel only having about 5% allocation to alternatives, that number, you talk to big distributors, I think that number is probably closer to 15%, which will mean some clients will be 0 and some will be 30. But as it's 15%, what's the best way to deliver it? Well, if you have a lot of money, if you're a high net worth, that might be in direct investments in those alternatives. But it also might be a managed account with a sleeve or a portion of that mutual fund or UCITS fund that has an allocation to the alternatives, right? And that way it creates a certain amount of liquidity that's important for a lot of people.
I mean, do all these changes change the fee structure?
So look, the biggest probably pressure on the fee structure on the traditional markets was, of course, passive, right? I think in the alternatives, it's really important to understand the best top-performing private equity managers, top quartile, outperform bottom quartile by 20% a year. Okay, top quartile versus bottom in real estate was 10% a year about, and private credit was 5% a year. The top quartile performers are oversubscribed, and so they're not feeling any fee pressure, right? It's about people continuing to make sure they can come up with liquidity. It's why there's a secondary business, because if there's a call for that top manager to start a new fund, you don't want to be left out. My worry is who's on sale. It's the bottom, who's going to have the fee pressure? It's the bottom quartile performing. And we have trained so many people to think only about fees that as we start to introduce alternatives and things like into retirement programs, and if it's just fees, the lower performing guys are going to be the ones who cut their fees, and you're better off being in the public markets than you are to be in a poor performing alternatives manager.
Jenny, I also want to ask about outflows. So you have been in a tough spot because of WAMCO. I mean, what happened?
Well, there's never much upside to talking about a government investigation publicly. So, look, it's a difficult situation. It was one person, and we're cooperating with the government on it. I think the most important thing is we still have a lot of clients invested in Western Asset Management, and so we have made sure that we insulated the investment team from a lot of what's going on with the investigation, so that we can ensure that they're managing clients' money and staying focused on that. And so that's been, what has been important for us to do.
Will you fold it closer into the business?
So our model has always been, and I think all the way back to when Franklin acquired Templeton, was, look, if you're in the asset management business, what are you buying when you acquire a company? You're buying people in their investment process. So don't destroy value by suddenly going in and messing with it. So we leave the investment team to be very much independent, and then we take things like the fund administration, some of the client service, and we tend to bring those things in, technology and those things. In the case of Western, the other thing you can't do in the asset management business is do a hostile takeover, because people can walk out the door, right? It's not like a lot of other types of businesses. And so in that, they negotiated a 5-year standalone. So they really have run independently as a company. And so we are now in the process of looking, what does it make sense to bring in? We've hired compliance folks to take a look at and obviously continue to enhance the policies and procedures within there. We also, of course, took a look more broadly at all the rest of Franklin's investment teams to ensure that we're confident with all the policies and procedures. And, the answer is we do what makes good common sense with each. So they're all slightly different. We usually let the CIO define a bit of what that is. And I go back to Mutual Series today has the traders sitting on the desk. Templeton says, I prefer to use the global trading platform. So it's what makes sense for that investment team.
How do you find the right acquisition? Was it a tough, you have been one of the most inquisitive.
Yeah. So I would say it's kind of the 3 C's on culture. Look, investment bankers will tell you why it's a great price and a great strategic fit, but they'll never talk about the culture and the people. And that is what determines whether a deal makes it or not. And so the thing that we look for culture, I say it's the 3 C's. How quickly, when you're talking to the team, do they talk about clients, right? Some pretty important clients. Do they collaborate with each other? Do they actually seem to like each other? And you can see a lot of dynamics on that. And then the third, do they have a mindset of continuous improvement, right? And especially at a time like now with all the technological innovation that's going on, if you don't have a mindset of saying, how should we be thinking? How should an investment team think about AI? I don't know that nobody has the answer, but if you are not thinking about it, you're going to be left behind. And so do they have that mindset?
How are you thinking about AI?
So, listen,
Did I pass the test?
I hate to tell you, but I love Perplexity, and all the media guys hate it because it's look. I can't remember the last time I Googled something. I go to the either ChatGPT, Claude, or Perplexity. I force myself to use it because you have to use it. Usually what happens with technological innovation is the first thing that people do is they make more efficient what they do today, because that's all we can imagine is what we do today. But as you start to get better at the tool, and so we rolled out Microsoft Copilot very broadly in the firm because we want people to use the tool, then they will start to come up with the next idea. When the iPhone came out, we said, oh, this is cool. It's a phone, a media, a flashlight, a camera. But what Apple was doing was they were unleashing the innovation of people. That is what AI is going to do, and we won't see it, and for a little while. Today, from an investment standpoint, it's all the picks and shovels. It's the NVIDIAs and the cloud services. But the real investment opportunity is understanding which firms in each sector actually start to make it be a differentiator, and it'll be very hard for the others in that sector to catch up. And so I think, part of the investment process is ask, well, what are you doing? Now, we have a strategic partnership with Microsoft that we announced, where Microsoft actually made us a strategic partner because some of the things that we had laid out, they said, are really challenging from a technical standpoint, and they wanted to be involved. They're actually providing us resources to build it.
How do you think about trade and tariffs? So Donald Trump will be inaugurated January 20th. I mean, are you expecting more deregulation? What does it mean for asset managers, or is it inflationary because of the specter of tariffs?
Well, so on the tariff front, I always say, remember, Trump is he's a deal maker, right? So if you're the deal maker, the first thing you want to do is express your position of power. So the greatest way to express that is say, I'm going to do all these trade tariffs on all these countries, and then you start there, and then you negotiate what you want. So you think about it and say, well, what does he want? In the case of Mexico, he'd like help on immigration. Actually, he probably really does want to reduce the amount of FDI investment from China. That's increased, I think in 2018, it was like 270 million. Now it's just under 6 billion. So he'll probably want some help there as they're reshuffling their supply chain. Europe, he'd probably like some help from a military investment. He'd probably like some help on the attacks on some of the big tech companies. So he'll use that as his negotiation. Now, there are going to be tariffs. And with China, I think it's just going to be tough. But remember, China has just responded with now saying they're not going to export a bunch of minerals that are critical to the U.S. Right? We have to remember, the U.S. needs China, and China needs the U.S. So there has to be a reasonable approach on both sides. And I think that will happen over time. But tariffs tend to be inflationary.
Do you worry about emerging markets? You're very embedded in a lot of the emerging markets that could be the biggest losers in this.
Yeah, they can. I mean, they've been pretty savvy. You figure out places where there's growth opportunity. One, either the China plus one supply chain. I know that Trump has said that he's going to go after and try to reduce some of that. But that's very real, and it's helping different markets. You can look at some, take in India. Look at India's going to grow just from domestic. If they could just get their domestic economy continue to go, it's going to be a great opportunity. 56% of the population under the age of 25. So, you have to pick your markets. We like Korea, Thailand in certain sectors. The consumer in Thailand we think is a good opportunity. So, it just depends, and you have to figure those out. That's why I like active investing.
There you go. Always a pitch. What about deregulation? Is it going to be good for?
I think he's expressed. I mean, it's only the last time we saw a president that was already in power was Grover Cleveland. So Trump's been in power. We've seen what he's done. He has said that he wants less regulation. He did that his first term. So I think we would expect to see that. And I think that tends to be good for businesses.
Good for equities. You have a lot of fixed income. I mean, there's talk about independence of the Fed, which he's now walked back on.
Well, it's interesting because if you actually do a bottoms-up earnings projection for next year on the S&P 500, it's like 14.5. It's slightly higher than that. So these are companies who are projecting their earnings being up, right? So they're looking at a lot of the tailwinds that are going on in the U.S. economy. Whether they're overzealous about what interest rates will ultimately do, who knows? But I think that it seems to be very positive for equities. And I think the good story in 2024 is that the equity markets broadened out as far as the returns.
So what's the best way? If I gave you $3 million, how'd you deploy those $3 million?
Well, if you could afford the illiquidity risk, okay? So I'm just going to tell you two that I love right now. One is secondaries, just again, because you had $6 trillion deployed in private equity, and you've had about $150 billion deployed in secondaries, and maybe another $150 billion raised. And we thought that it would dry up once the equity markets came, but the reality is, when the IPO market has slowed down, people need liquidity. And so they're going to secondary managers, and the returns, we're seeing some of the best discounts that we've seen in the history of it. And the second one is actually real estate debt. And here's why. Most of the regional banks were the big lenders in the real estate market. And the reality is the office if you're not a grade A office, I think a lot of the real estate people would say, we're still not sure we've seen the bottom yet. Right. But what you see a lot of the bankers saying is, hey, don't hand me the keys back. I'll give you a good term rolling it forward. But that means that they're not lending to the new developers out there. And so we're seeing that there is a real opportunity. So Benefit Street Partners, our private credit manager, actually has about $9 billion in real estate debt. They were having conversations with Clarion Partners, our real estate team, real estate managers, saying, hey, if we end up taking over any of these properties, we'd love to talk to you about how to think about monetizing it and maximizing return. And in it, they identified that there's this real opportunity, because as these regional banks have stepped back, you can't just be a private credit manager and say, oh, today I'm a real estate expert. You actually have to have that expertise. So we think that's another really interesting. So those are two I'd say go for.
And Jenny, in terms of interest rates, are we higher for longer, given all of the uncertainty out there?
I'd say with the U.S. deficit, I don't see how in the debt. I don't see how that you can't. You obviously have, pretty robust economy, all those things. I mean, but I think most people think the Fed will cut in December. I think it's something like the 87% likelihood or something projected.
But afterwards, it's
tepid. Maybe two more, but then I don't think, I think it's higher for longer. And again, I think people are underestimating the risk of, or not the risk, because the U.S. is still going to be the reserve currency, and you're still going to be able to always finance it because there doesn't seem to be another, option. But at what price does it crowd out other investments? I don't think that's a 2025 problem, maybe not even a 2026 problem. But at some point, this becomes an issue.
But this is what, a diversification away from U.S. dollar reserves?
Well, I like I said, I don't think it's a 2025 or a 2026 problem. So I think it's somewhere further down the road. Okay. But I do think it keeps rates up a little bit.
Final question: what's your priority for 2025?
I think we did these 10 acquisitions, and now it's about digesting and finding opportunities. Like this real estate credit example, came because two CIOs were having a conversation just to try to gain some insights from each other, and they're like, we see this dislocation in the market. Like, one of the key things that we do is twice a year we bring all our CIOs together, both from public and private side, to just get to know each other. I always say the dinner's more important than any topic, because as they get to know each other and they get curious and they're comfortable asking questions. I mean, it was really fun to be sitting there watching the value guy and the growth guy debate the valuation of NVIDIA, both in their core. I always think one's a pessimist and one's an optimist, but in their core, their view on what that is, that makes for healthier investment teams to have that kind of access. And we can provide that 360 view of capital markets to all our investment teams, which I don't think you get in most other firms.
I'm tempted to ask about NVIDIA, but that's our next panel. Jenny, thank you so much.
Thank you.
Jenny Johnson.
That was Francine Lacroix, of course, speaking to Jenny Johnson, President and CEO at Franklin Templeton. I'm Anna Edwards. We are live on Bloomberg TV and on Bloomberg Radio at Bloomberg's Women, Money and Power event. Welcome to the program. We're keeping across all of the events that are happening on the main stage here at this event. Terminal subscribers can also follow along if they wish to. TLIV is the function to use to find the TLive blog. So there you'll find our journalists keeping track of all the conversations that are taking place and bringing you any headlines from them. You can also join us virtually at Bloomberg.com and on the Bloomberg Live channel on YouTube. And looking ahead, I'll be hosting a live Q&A about the event, about some of the headlines coming through from the event. A lot of talk about M&A here. We will be joined by a crypto in-house expert. We will also talk about the finance industry. We just heard from Jenny Johnson there about many aspects of finance. We'll put all of that under the microscope. 1 o'clock London time for that Q&A event. You can find that on the Bloomberg terminal and indeed on the Bloomberg website. Now, Citigroup CEO Jane Fraser is entering the final stages of her efforts to simplify and streamline the American bank. But investors remain tepid, with the stock lagging behind peers and analysts predicting she'll miss her 2026 profitability goal. Fraser spoke exclusively to Bloomberg's Shanali Basak ahead of the Women, Money and Power event.
Jane Fraser is the CEO of Citi, and she's reshaping the bank. It is one of the most transformational changes to U.S. banking in a generation, and she has a unique perspective of challenges and opportunities ahead as the leader of the most global U.S. bank. Jane and I sat down at Citigroup's New York headquarters on November 12th, and this is part of our conversation.
Given the world is changing so quickly, where is the most promise over the next 5 years? And what regions of the world do you see as lagging?
Well, I always like to talk about bright spots first. So I think the bright spots is America. If you talk about a lot of roads leading here, fantastic entrepreneurship. I mean, this country is incredible. I love how Japan is turning up, focused on returns, moving from savings to investment. Entrepreneurs also on the front foot there. So that's exciting. Most of ASEAN as well, really adapting and adopting a lot of new technologies. The Middle East is a different Middle East. As a woman, I find it really exciting to go there and see how quickly it has changed, and the female population is being unleashed in many of these countries in a very positive way. And I wouldn't forget Brazil and Mexico as areas where we're also seeing tremendous innovation. So I think those are, that's a pretty broad group of winners there. Europe has a tougher time. They've got some more structural challenges. Labor market is not as flexible. They don't have the scale that the States has. And they've got some challenges in terms of competitiveness. So that would be a quick walk around the world of the highs.
While the world is changing, so too is the world of finance.
Yes.
In particular, you've seen for many years now the banks cede some share to the non-banks, and you made a lot of news this year when you struck a partnership with Apollo, a $25 billion partnership in order to provide more private credit to your clients. Where do you see the private markets going at the end of the day?
When you look at a transaction and a partnership like the one we have with Apollo, you're looking at a win-win. And as we look at it, we're marrying our strength in origination and some of their power on their balance sheet in areas that we can't compete with them on, and put it together in 1 + 1 = 3 for our clients, because we're still giving our clients choice. And I think that's what we see the private market as. In non-investment grade clients in particular, and companies, it's giving them an additional market to tap into. Some points, the private and public market, there's no arbitration between the two. Last couple of years, you saw the private market advantaged. The goal here from our perspective, give the client as much choice as possible. Again, what does it mean? I come back to America as a proud immigrant. What you see here is the depth and breadth of capital market. We are 50% of the world's capital market. We keep innovating. The scale and specialization it affords is really tremendous. You just don't see that as much in the rest of the world. And that, I think it means, why does the US keep being the winner in the global financial and capital markets? It is because it deserves to be.
At that end, too, what is the biggest risk to the industry over the next 5 years? Where do you have to look around the corner the most?
The piece that keeps me up at night is always cyber risk. And I think when we think about fraud, AI, and cyber, and the sort of convergence of those capabilities, and the speed with which activity can be done now, and that compute is going, that definitely continues to keep me awake at night the most. So I think that is the larger threat. At the end of the day, this industry is about trust. And so I think all of the larger institutions are putting a lot of resources to make sure that we can protect our institutions and our clients.
Jane, where do you see Citigroup in 5 years? You have embarked on this massive transformation. What is your greatest ambition?
Oh, well, my ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about, we've got the right strategy and vision, we're executing with the right organization, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
Our exclusive interview there with the Citigroup CEO, Jane Fraser, speaking to my colleague, Shonali Basak. Now, Bloomberg's Chief Content Officer, Heather Harris, is busy moderating, just getting underway with a panel on private credit, the private credit industry here at the Bloomberg Women, Money and Power event. So let's listen into that.
I'm told if you have any questions for our panel, please remember the QR code is there and we'll be able to see them here and hopefully squeeze some of them in as we go along. So as Jenny mentioned, one of the trends we've seen obviously is private equity held companies staying private for longer. We've also seen the ascent of private credit reaching ever new heights. We're seeing deals between banks and private credit firms. So a lot to unpack in this session. So Anne, I'd like to start with you, please. You've obviously seen the entire evolution of private credit sitting in your perch as Chief Investment Officer at Guggenheim Investment Management. Can you talk a little bit about where you think we are in the cycle of private credit right now? So obviously we've had a big boom since the GFC. We're now hitting, I think by last account is $1.7 trillion in private credit. Where do you think we are heading into 2025? How's the market responding to the higher rates that we've seen, and where do you see the biggest opportunities for investors now in this market?
So thank you very much for having me and us as a panel. Let's start with sort of the backdrop where we are. So about 7 to 10 years ago, we saw a real shift in capital markets in the U.S., where we really moved away from a public market paradigm, which we had historically. We're down to approximately 3,500 or 3,600 listed companies in the U.S. relative to private equity-owned companies, which are about 5,500. And as I said, that sort of crossover occurred nearly a decade ago. And ever since then, we've been on this sort of a trajectory and evolution with regard to more private investment that's been going on. In particular, when you have private equity-owned companies, they're not necessarily going to want to access public markets. They're not going to want to be able to have that or be required to have those kinds of disclosures. And they're going to go to private capital providers. And so that's why we've seen this evolution of an increase in private credit. And if you look at the markets, if you look at particularly non-investment grade space or leverage space, the public high yield market has declined in size relative to the private capital markets as well, and private credit. So we've had this sea change in capital markets. And along with that, we've had global central banks, particularly post-COVID, let's go all the way back to the financial crisis, but even more recently, who have pushed a huge amount of capital and liquidity into the system. If you get a sense of it, post-COVID, about $12 trillion globally came into the global capital markets. Some of that has been removed by central banks as they've migrated towards quantitative tightening and trying to battle inflation. But there's still a whole lot of excess. Only about half of that has actually come out of the system. And so even adjusting for GDP growth, we probably still have $3 or $4 trillion that's left sloshing around, providing this excess liquidity, which I think really supports the private capital markets, not just in the US, of course, but also globally at this point in time. So I think fundamentally, we're in a pretty good place for private credit, and I think this growth and evolution will continue. And I think the trajectory, I've seen estimates of potentially $4 trillion in private credit going forward relative to where we are now. So we could see a doubling of the size. And I think one of the elements that would potentially drive that is a way for retail investors to somehow move into private credit, which right now that's really not happening. It's at the very beginning in some cases, but that will also drive that development and make it more, shall we say, the democratization, if you will, of private capital.
Thank you. So Danielle, I'd like to come to you next. I think you've seen about 10 years of private credit evolution at Oaktree. Can you talk a little bit about, what surprised you the most about what we've seen this year in trends in private credit? And then secondly, what has the US election result done to the market? How has that changed your assumptions heading into 2025?
Of course, and thank you again for having all of us here. You know, I think one of the biggest trends really has been the convergence between private and public credit. And, you know, sometimes they're pitted against each other as rivals. And the dramatic growth that we've seen in private credit over the last 10 years, really more just in the last 4 or 5 years, is often described as taking away opportunity from the public markets. But I think that the combination of the two, they've really started to exist more symbiotically, and it's actually helped borrowers in the overall health of the financial system this past year. And so what I mean by that is if we look back at 2022 in particular, back then banks were hung with loans, the public markets were a little spooked with volatility, and private lenders stepped in really to provide a lifeline and stabilize public credit companies. Flash forward to this year, 2024, and we've seen public markets be more comfortable with the economic environment for rates, and we've seen their financings boom. So this year in particular, we've seen a number of deals move away from the private market into the syndicated market. Actually, 20 billion of deals that were refinanced in 2022 deals, 20 billion of those this year have actually been refinanced into public markets, which is significant. There's always going to be certain companies that need to be in the private market because of their size or needing nuanced financial solutions, and we're starting to see hybrid solutions be announced. So earlier this year, Ardana did a public-private hybrid where 5 billion and 2 of that in high yield and 3 in private credit. And so I think they're keeping their financing options open. So where does it go from now? With Trump, he did run on a lot of pro-business policies, and in particular deregulation and corporate tax cuts. And on the deregulation front, we're optimistic that that should lead to more M&A activity. And that would be, good from a financing perspective. And then also with the tax cuts, it should boost profitability of the companies that we're lending to at the same time that rates are potentially falling. And this creates, I think, a really attractive time to be a credit investor.
So more boom times into 2025 then. Yeah. So one thing you mentioned, obviously, is the banks and regulation. So Alison, I'd like to bring you in here, as obviously you spent most of your career in commercial banking, including since in leveraged finance. So one thing that's really defined 2024 has been all these tie-ups that we've seen between banks and private credit firms and how that plays in to everything that's going on in the markets. And so is it you can't beat them, you join them, the kind of, uncomfortable frenemies relationship that we're seeing? Jane Fraser referenced it in her interview. It's, she calls it a win-win-win. If you're a bank, how are you feeling about this, and what are you getting out of it on the ground floor?
So I think it depends of which lens of the telescope you're looking at. Right. So I think from a client perspective, the innovation and growth in the private credit market is fantastic because there's more choice, there's different pools of capital, and it means you're less tied to the opening and closing of the public markets, and there's more access. So I think that's a huge positive. Clearly the banks are catching up a little bit on this as more regulation post-financial crisis has gone into the banks at the start of the value chain. You've seen, less of their balance sheet being used for leveraged loans, and that was the first kind of real move in private credit. It's now moving into corporate and investment grade and moving into the traditional balance sheets. I think depending on what type of bank you are, it is a win-win situation because with the constraints on balance sheets, the regulatory restrictions, the cost of
we will duck out of that conversation there. Bloomberg's Heather Harris in conversation with Danielle Polly of Oaktree, Alison Rose, who was just speaking there, of Charterhouse, and Anne Walsh of Guggenheim. Much more to come from the Women, Money and Power event here on Bloomberg TV and on Bloomberg Radio. Later on today at this event, we'll be hearing from the Man Group CEO, Robin Grew, the Executive Chair of Santander, Anna Bottine, also among many other voices. Have a good day, everybody. This is Bloomberg.
first time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Granny. You're welcome to Bloomberg Brief. Let's set that agenda. Global risk markets mark time. Enthusiasm for China's stimulus pledge fades. Investors look ahead to the CPI later this week. A tale of two AIs. TSMC scores 34% November sales growth amid sustained demand. Oracle falls on lofty expectations. And we're live to London at the Bloomberg Women, Money and Power Conference. Conversation with Man Group CEO Robin Groove coming up in the show. Good morning. We're marking time in these equity markets. What I can tell you is SocGen are saying get ready for 1,000-point swings next year. You're going to trade between 6,500 and 7,500, and it is going to be anchored with where the Treasury market is. By the way, momentum had its worst day of 2024 yesterday. Just saying. Roll it over and have a look. By the way, we'll catch up with Callum Pickering and we'll talk about whether prices are high or expensive. Here's the bond market. SocGen, as I say, suggests that your equity rally is inextricably linked to the bond market. PIMCO have a pretty big note out that we've talked about on the Bloomberg terminal. Vigilance before vigilantism. They are less inclined to buy duration. They are reducing their allocation to the longer end of the curve. Steepeners are us. We'll talk about vigilance before vigilantism in just a moment. We're also keeping an eye on Alibaba falling after the Chinese signaled a bolder stimulus and eased their monetary policy stance. MicroStrategy rising in the pre-market after an announcement that it bought another $2.1 billion in Bitcoin as its funding draws scrutiny. And C3 AI shares climbing after the AI software company boosted its full-year revenue forecast. And in just a few moments, we'll sit down with Callum Pickering, chief economist at Peel Hunt, and later this hour, Simi Shah joins me from Principal Asset Management. But first, investors are bracing for a new market environment.
This is dessert first in some ways, where everything is still possible. We haven't had the full cabinet announced. We haven't seen the actual policy proposals. This is a point where the market is free to dream and imagine that their preferred version of the next administration will be the version that we get. And that's a powerful force. Optimism, the dream is an incredibly powerful force in markets.
Let's see what Callum Pickering dreams about. He's the chief economist at Peel Hunt. That was Andrew Sheets 24 hours ago. Dessert first, we dare to dream. I've got you down as a pragmatic Scotsman. But what level of dreaming and optimism do you have? Good morning.
Good morning. Oh, well, I'm constructive by nature. When I look at U.S. markets, you mentioned this question: are prices high? Or are they expensive? Well, let's ask the question: what would need to happen to justify the high prices? Let's just play out next year. Resolutions onto geopolitical conflicts, the bond market to swallow the tax cuts. They're not inflationary. Europe strikes a deal on trade. Canada, Mexico strike a deal on trade. US, China
you are
don't
looking for
escalate
a lot, brother.
too much, and the deregulation helps reduce US deficits, and we still get growth surprises to the upside in the US. That, for me, is what needs to happen to justify US stock prices. I think that's going to be hard. The question is, how does the correction play out, and at what point does it happen? Because if we're exuberant for 6 months, you won't want to miss out on that.
Do you think we should prepare for this kind of violent 1,000-point swing that SocGen talk about? I mean, look, they're putting their year-ahead forecast out there, inextricably linked to bonds. But I do get the sense that whilst we're all super optimistic and suffering a bit of FOMO, we should prepare for quantums of volatility.
Yes, I think so, because there's just so much material stuff to work through next year. What will be the net balance of effects of potentially immigration curbs, trade tariffs, and domestic tax stimulus? Will that be inflationary? Will it be pro-growth? It depends on how other actors respond. That's Europe, that's China. It depends on how far Trump goes on these particular measures. And then there's just the underlying US economy. Actually, the situation's been good. This is an economy that's been growing above potential for some 3 years. And what I grow nervous about is when everyone dismisses risks, and what you find there is the prices today reflect the fact that we've been outperforming in the US for 3 years, or that you're likely to outperform for the next 2 or 3 years. I think it's the former rather than the latter.
So the risk, a lot of people sit in their seat and they say, you need growth for the equity market to continue to march higher. The biggest risk is, of course, that you have sticky inflation and a less aggressive Federal Reserve. And that sticky inflation is perhaps one of the biggest risks for 2025.
I'm worried a bit less about inflation.
Okay.
Just keep in mind, if Trump introduces aggressive trade tariffs near term, in the end, US consumers will pay for this somehow, but that would mean a stronger dollar. So you'd get a compensatory effect. So imported prices via a higher dollar would come down, and then you would get the effect. So that's not clear which way it goes. It won't be the risk that people are worried about. What I think we've got here in the US is a strong productivity upswing, which is helping to bring price disinflation down and keep it under control. We had something very similar in the 1990s. Greenspan didn't raise interest rates into an upswing. Why? Because he saw that productivity was strong on the underside. So I think that's the story with productivity. What makes me much more nervous is US 7% deficit. That's a problem. What happens if, for whatever reason, you get a business cycle downturn and you get some unemployment? And what happens if the good news priced into markets just doesn't play out, and you go from speculative fever, which is I'm exuberant, prices are high, I think they can move higher, to ouch, actually the world's not like I thought it was before. And then you'll get these sharp corrections. So I don't think inflation's the risk. I think it's a medium-term risk. I think next year it's the deficit, and it's just what's priced into markets that will be a big problem.
Then you probably subscribe to PIMCO's view, vigilance before vigilantism. Will vigilantism return in the way that we knew it in the 90s?
I think that we're going to have to see in the data. If we just look squarely at the balance of policies, tariffs are a negative supply shock, pushes up prices. Immigration curbs, negative supply shock, pushes up prices. Demand-side stimulus in an economy at full employment with 3% growth that's already running hot. The next thing to see is a little inflation. But when I look at US 10-year rates, we're trading at 4.20 today, that's barely 2% real GDP growth plus 2% inflation with a tiny bit of term premium. So there's a lot of trust in the US bond market that things are just going to play out fine. What happens if we don't get a fine outcome? And since the risks are spread to the upside, I think there's a risk that at some point next year, after a period of exuberance, the bond market just sees the whites of the eyes of inflation and then corrects.
And this is what we've got. We've got the term premium here, Callum, which is the ratcheting in term premium into the election. Now, we've come back a little bit. We're actually at a 1 month low. And my question is fairly simple. That term premium, what is that pricing for me? Is that pricing status quo or next year? Or is there enough in there to really warrant being long of duration at the moment?
Well, the bond market, the US equity market is pricing in and everything will be fine scenario. And the rule over the past few years is we get overtaken by events. I hope everything will be fine. And I think the market, seeing prices rise, will not want to miss out. That's the FOMO that you mentioned. But we just need to recognize that underpinning this good situation today is a lot of two-sided risk. On the one side, inflation, on the other side, deficits. How can things get materially better from here would be my question. It's only on that basis you could then say prices need to move higher.
But for things to materially get better, you just need to take out the blocks, don't you? Which is tariffs are less aggressive. Deficits, Besant, Treasury Secretary-elect, delivers some kind of a deficit narrative that the bond market likes. He's targeting 3%. Yep. So there's various blocks that can be removed throughout 2025, aren't there?
I expect next year that we will probably get okay growth from the US, let's say 2% at moderate rates of inflation, and we'll feel like we're getting away with a lot of this. I don't think the deregulation on its own will be enough to bring down the US deficit to a sustainable level. I think you'll need active measures, whether that's the expiration of some of the spending that are not followed up by more spending, or whether it's active tax hikes. If we were to get negative supply shocks, which suddenly gave us 3 or 4 months of upside surprises to inflation, I think we'd find actually that bond market pricing is quite fragile. That would be my fear.
Okay, the fragility of the bond market. We're never far from a vigilante attack. Callum, thank you very much. Good to see you this morning. That is Callum Pickering of Peel Hunt. There are other stories trending on your Bloomberg terminal this morning. The Brazilian president, Lula, is in intensive care unit undergoing emergency surgery, according to an official statement from the hospital. A brain scan showed intracranial hemorrhage from an accident that he suffered at home in October. The procedure was uneventful, and he is in good health and being monitored. Israel stepped up its attacks on the military sites in Syria, striking some 250 targets, sending troops deeper into the country. The attacks follow Israel's seizure of a buffer zone along its border with Syria and airstrikes on Syrian chemical weapons. Israel's army radio, citing an unnamed defense official, described it as one of the biggest strikes in the Air Force's history. Prudential is considering options for its asset manager, Eastspring Investments, that includes selling a minority stake to help broaden the business, according to people familiar with the matter. A potential stake sale could value the Singapore-based Eastspring at about $3 billion. Coming up, TSMC sales grow by over 30%. We'll bring you the very latest on tech and AI in just a moment on Bloomberg Brief.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the days top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Manny Scranny in New York. Oracle met its estimates for revenue last quarter, but the investor expectations, well, they reached beyond the estimates. The stock fell 7% after hours, and the negative sentiment is continuing in the pre-market trade this morning. Let's get to Tom McKenzie. He joins me now. Tom, I mean, the market reaction here on Oracle, first of all.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Out by Google, of course, part of the Alphabet family, and Meta to target under 18s in terms of advertising to push Instagram to that audience on YouTube. They tested it, they did a pilot in Canada, they were rolling it out, and then they pulled back from it. It actually went against Alphabet's own internal policies. The EU is asking for data and information as to what was going on behind this, again, reported secret deal, advertising campaign between Google and Meta.
Tom, great reporting. Great up, Tom McKenzie there in London on the big tech stories. Coming up, we're going to hear from the Man Group CEO, Robin Grew, at Bloomberg's inaugural Women, Money and Power Conference. Context matters on Bloomberg.
Important is the thing that I think is important in that scale debate or that conversation too. So can you deliver what you have at scale efficiently and return as much alpha to clients as possible without losing?
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Get you up to speed with the front page news from around the world. These are some of the headlines. First up, the Journal starts with McKinsey promoting the smallest group of partners in years. The consulting giant elevates roughly 200 employees into its partnership. That's about 20% less than last year. McKinsey is still expected to expand its overall headcount throughout this year. Next up, CNN reports the Biden administration is rushing to secure a ceasefire in Gaza. Talks over a deal have resumed quickly but quietly about the ceasefire between Israel and Hezbollah. President-elect Trump says he would like to start his second term with both Lebanon and Gaza conflict wrapped up and the hostages held by Hamas released. And on Bloomberg, Luigi Mangione has been charged in New York with the murder of the United Healthcare CEO Brian Thompson. He was arrested by the police at a McDonald's in Altoona, Pennsylvania, after being alerted by one of the employees. A 26-year-old man was found with a homemade gun and a manifesto which was described as anti-capitalist and of critical healthcare company's profit motives. Well, as we said, we have the Women, Money and Power event in London. Let's listen in to the Man Group CEO, Robin Grew.
You're going to find us thinking about opportunities like that, but you'll also find us growing organically our business. So, between our private and public credit business, we're north of $30 billion. And you can see that that matters to clients. I talk about clients all the time because they feed both how smart we can be. The danger is if you think that we can all turn up and sit at the table and come up with the singularly brilliant idea, that'd be great, and maybe we can do that from time to time. But actually the benefit is to have the brightest minds in the room, and that's between my firm and with everybody that we work for and with, to come up with that nugget of brilliance. And in listening to clients and being responsive to clients, it's about growing content, capability, asset classes that can answer their questions and be part of answering some of the navigation points we have today. It isn't straightforward out there. So we're going to see Man Group will grow through organic growth, through acqui-hires. If we can find acquisitions that are genuinely additive to us and accretive to us and to our clients, we'll do that. But it's a constant thing that you need to have at the front of your mind.
So as you look across your business, what products would you be most interested in potentially growing through acquisition? Are there any gaps that you see you'd like to build? Or
I think that it's a great question. It's one of those ones, though, that suggests that somehow there's a menu from which I can choose from at any opportune time. Wouldn't that be nice? That doesn't work like that, unless, if you know better, please let me know. So it is about assessing what's out there today and what's available at the right multiple, the right price, with the right scale, with the right culture. What I will tell you is it won't be something that we currently do. It will be something that adds uncorrelated content or capability for us. And when I say for us, I mean for clients. So what would I be interested in looking for? Do I like credit? I think credit's a cracking opportunity still out there. Can I grow it? Yes. Could I buy it if I can find the right thing? For sure. What I won't be after in this space is something which you can't scale. I think that there are very smart people in this audience today and very smart people sitting in my firm. And we can all get quite excited by small and niche businesses that do really funky and fantastic things. We can all be slightly distracted by them, and it's brilliant, by the way. It's not to suggest they're not valuable. But if you can't deploy them at scale, that's less good for allocators who are trying to put money to work. So it's about having discipline in this space as much as anything else.
what about Man Group itself as a potential target? What do you think?
I think that I sit in this rarefied position of the CEO of this business, and it's a cracking business. It's been around for a while, you just mentioned, and my job, apart from anything, is to make sure that it is around for a lot longer.
That's the Man Group CEO, Robin Grew, there, trying to deflect the last question about being a target, Man Group being a target, from Caroline Gage there at our conference in London. Women, Money and Power. The event happens today. Type in Live Go on your Bloomberg channel. You can listen to the rest of the conversation with Robin and the board of speakers throughout the day. Coming up, the ECB will need to cut more than the Fed. That's the view from Principal's Seema Shah.
be easy, but at least there's a theory of change.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Manish Cranny. Let's set that agenda. Global risk markets mark time. Enthusiasm for China's stimulus pledge fades. Investors look ahead to the CPI later this week. A tale of two AIs. TSMC scores 34% November sales jump amid sustained demand. Oracle falters on lofty expectations. In Citi's critical year, Jane Fraser is halfway through her 5-year plan to turn the bank around. Our exclusive interview coming up. Good morning. Having a look at equity markets just eking into the green. Momentum had its worst day of 2024. SocGen say get ready for a 1,000-point swing around, 6,500 to 7,500. We must debate whether prices are high or expensive. Seema Shah can answer that question. Let's roll it over, have a look at the bond markets. Fairly flat. PIMCO have a big note out that we've upsunned on your Bloomberg terminal. Flat, 4.21 is where we are on the bonds. PIMCO believe that we will have vigilance before vigilantism, and they are less inclined to buy duration. Reduce your allocations to longer dated bonds. You're going to have a steeper yield curve. Of course, we're kind of down to the CPI. So much of this market narrative about where we go in 2025 will be predicated on the potential policies set by the incoming president, Donald Trump. He set the test, the economic resilience around the world. Global growth is set to come in at 3.1%. That is flat from 2024 in the latest economic outlook released by our Bloomberg economics team. Jamie Rush is part of that team putting this grand paper together. Jamie, good to see you. Look, we're just over a month away from the new administration. And in terms of the seesaw of expectation, it is about tariff, it is about tax, it is about immigration. What's the base case for you and the team at Bloomberg Economics?
Well, I mean, the base case is that we think he's going to be relatively moderate. We have moderate voices in the administration. We know that if he was to do some of the things he's talked about on the campaign trail, like 60% tariffs on China, that would crater supply chains for US companies. He'd be punished in the markets for that. And so we think all of this points to him taking a slightly more moderate view than he's talked about on the campaign trail. And if you look at the Trump 1.0 playbook, you see that he was very careful the way he targeted tariffs. They were designed to reduce the inflationary impact. It was all on intermediate goods. And this made quite a big difference to the outcomes for the US economy. And we expect so there will be some similarities with that going into the Trump 2.0.
I just had a conversation with Callum Pickering, of course, from Peel Hunt. He's saying, yeah, okay, so you get the tariffs, but potentially that stronger dollar, which to a certain extent or a proportional extent can offset some of the impact. Let's talk about inflation. There's a discomfort for you in where we land in 2025 in the United States and the UK. It's going to be uncomfortably above target in 2025, and that has ramifications.
Yeah, I mean, that's right. I mean, if you look at the global economy generally, what we see is a picture of really quite surprising resilience. If you think about the hiking cycle, if you'd asked any economist what that would have done to the economy, they'd have said it would have caused a recession. It hasn't, and as a result, labour market's still tight. We're still seeing inflationary pressure dissipating, especially through the US and the UK, not so much in the Eurozone. And clearly this is going to limit the capacity for many central banks to cut interest rates over the coming year.
Okay, Jamie, thank you very much. You can pick up the latest economic release on your Bloomberg terminal. Jamie Rush there of Bloomberg Economics. My guest this morning is Seema Shah, Chief Global Strategist over at Principal Asset Management. Seema, that's the Bloomberg house view in terms of uncomfortably high inflation above target and steady as she goes growth of over 3% in the world. For you going into 2025, what's your growth outlook, first of all?
Hi, Manus. Yeah, actually very similar. So still expecting a soft landing, actually probably more than a soft landing, like fairly solid growth through the world next year. A lot of divergence, so you've still got the US leading. But that strong growth from the US should almost shine on the rest of the world and help bring up growth expectations everywhere. I think the key concern, as you pointed, is still going to be inflation. As long as you have got solid growth, plus you have all of the risks around tariffs, tax cuts, immigration, there is a chance that the US is going to have higher than expected inflation, which of course is then going to feed through to the rest of the world.
But do you think that can feed through to vigilantism? And this is the principle of what PIMCO are talking about. They see vigilance in the bond market before vigilantism. They talk about you don't really want to be long duration. If my risk is intransigent, sticky inflation, and indeed, if that is one of the biggest risks, and perhaps fiscal largesse, can you envisage that kind of roadmap, which is vigilance for now? We've traveled down in yields, but the potential there is for an attack of vigilantism.
I would entirely agree. I mean, I think when we look at what's likely with the regards to inflation, or actually with regards to rates, generally speaking, or historically, once the Fed has started to cut rates, bond yields have headed down. I think this situation is quite different in that you still have a very strong economy. If anything, economic expectations have improved since the Fed started to cut rates. And then, of course, as you said, on top of that, we have all the discussions around deficits, which is not just focused on the US, but you've already seen across in France, in the UK, that this is a global discussion. And as long as it's a global discussion, there's going to be global upward pressure on bond yields. So I'd agree. I think there's more of a risk of upward pressure on yields than there is downward.
I'm trying to get a grasp on what people think 2025 is going to look like from a risk principle. I take my mind back to the first Trump administration. It was overnight tweets, and it really dislocated the market. It created these massive air pockets of volatility. And this plays to what Soc Gen are talking about. Get ready for 1,000-point swings in the equity market. Now, you mightn't have that overnight. I don't know what we'll get next year. But is that what you're preparing for? Air pockets of massive volatility, which can create, I would say, opportunity rather than outsized risk.
So I think it's a really good point. So when we're looking at next year, we have got a fairly constructive perspective. We're expecting, as I said, solid growth. We're expecting fairly moderate Trump policy relative to Trump 1.0. But that is a concern, and that is a consensus view, which means that there is always going to be the potential for some kind of surprise, a bit of a risky atmosphere. And as you said, Trump 1.0, he did have the tendency to throw a little shocks into the market. And when you have got valuations as extended as they are today, both across the fixed income market and the equity market, that really does suggest some significant vulnerability. So the market, or at least the economy, needs to deliver, but we also need to not have any kind of surprises. So to me, the risks are a little bit to the downside, but the broad baseline perspective is a solid, or at least a modest, upside move in equity markets through 2025.
See, the worst mistake any of us could possibly make is to be sat out and under-allocate into 2025. How are you gripped by FOMO?
I think everyone who hasn't been invested or hasn't been sufficiently invested has to have some FOMO.
Yeah.
Just looking at the way that the market has performed, there hasn't really been any space which hasn't done well. It does mean that in 2025, it's going to be a little bit more challenging, of course, to get the same kind of returns. So we're not expecting like the 25% S&P 500 move that we've seen this year. We're not expecting credit spreads to continue to tighten. But that doesn't mean that you shouldn't have some kind of exposure, because as long as we're not anticipating recession, these risk assets can continue to perform fairly well. You have to be, as you said, there's going to be opportunities. Every time there's a dip, that's going to be an opportunity for investors to increase that exposure that maybe they've been struggling with under any of their FOMO emotions. So I think there will be opportunities, but certainly staying invested is going to be the key thing going into next year.
Well, let's face it, there's enough cash on the sidelines in money market funds to justify taking those opportunities. Laurie Calvasino says, look, we've possibly pre-traded some of the political tailwinds. I want to look at you very clearly draw this differential between Europe and the United States of America, and you talk about a juxtaposition of US strength and European economic anemia will be exacerbated in 2025. Stagnant economic growth implies continued disinflation, and the ECB will have to cut more than the Fed. What are the ramifications of that narrative?
Well, I think, first thing is that what we've seen from a political side in the US has simply reinforced a narrative which is already underway of US exceptionalism and Europe continuing to struggle. So this isn't a change in theme, I think, for anyone. This is just kind of almost exacerbating what was already there. For the ECB, of course, we are anticipating significant rate cuts through next year, taking it below neutral, whereas for the US, you could potentially see rates above neutral. Now, from a market perspective, it gets somewhat interesting because, generally speaking, that difference in fundamental perspective should suggest that US market should outperform. But the one caveat to this is that expectations for Europe are so negative. There is so much pessimism built into to the way that investors are thinking that you would need just to have a slight positive surprise in order to prompt some kind of positive movement from investors in terms of flows. Remember, valuations are very cheap in Europe relative to the US. So any kind of upside surprise, I would think, as a good opportunity for investors to increase exposure. We're not there yet, but we've been keeping a very close eye out for that.
Okay, we haven't quite reached that line of where you jump in. Seema, great to have you with me this morning. Seema Shah of Principal Asset Management, joining me on Markets from New York. Good morning.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
About artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It is Bloomberg Brief. I'm Manus Cranny here in New York. Oracle met estimates for its revenue last quarter, but the expectations were for something a little bit loftier. The stock fell 7% after hours. The negative sentiment continuing pre-market this morning. Let's get to Tom McKenzie standing by. Tom, I'm just looking at the AI demand in these numbers. It is spectacular, up 336%. Why the misery?
Expectations, Manus, as is so often the case with the AI earnings story. One analyst quoted by Bloomberg saying the bar was just set so high after two blowout quarters. This was not the blowout quarter that some had expected from Oracle. But also, it was not a miss. They met estimates. As you said, revenues were up 9%. And importantly, from that cloud division, the cloud infrastructure part of the business that they're putting so much emphasis on, you saw growth there in sales of 52%, in line with estimates. The guidance on the current quarter, Q3, missed estimates. There's concern there. But again, executives at Oracle saying that they are still very confident in their strategy. They talked up some of their big customers like Meta, who will be training some of their AI agents on the hardware and software applications that Oracle provides. And again, this is a stock that's up more than 8% year to date. So with a bit of a breather, pre-market, you are looking at this big hit. But most of the analysts out there that have passed through these results suggest that the demand and momentum is still there for Oracle.
So what's happening with TSMC? I mean, they had a hugely robust November. They have dominance that is the envy of Samsung and Intel. What's the read out there? The stock's just lighter on TSMC this morning by 1 1/3.
Yep, so sales up in November year-on-year for 34% increase a month year-on-year for the month of November. By the way, cast your mind back to January, where you saw sales of just 7.9% increase for TSMC. Most recent months, you've seen plus 30%. The expectations are now that for December, you'll see an increase in sales of about 36%, so it's looking healthy. Bloomberg Intelligence say these numbers from November suggest they will hit the higher end of their guidance for TSMC, which, as you say, Manus, is a bellwether in terms of that AI and data center demand. The growth coming through from the most sophisticated smartphone chips, but also that infrastructure, the servers that they provide into those data centers. It's a positive set of results for TSMC, and again, suggests that demand is going to continue, the momentum into 2025. That's the take from Bloomberg Intelligence, but they also say the scrutiny on those numbers month on month through next year will be intense.
Yep, well, they certainly got the dominant position, and as you said, Tom, a little bit earlier, they have that pricing power. Tom, thank you very much. Tom McKenzie tracking the tech story. Turn our attention to politics. President-elect Donald Trump's picked for Defense Secretary Pete Hegseth plans to keep fighting for the job. Hegseth appeared on Fox News and said Trump urged him to persist. Let's get a little bit more detail now with Bloomberg's Mike Shepard in Washington. Mike, good morning. Good to see you. So he's not backing down, but it also would look as if he has some kind of a shift in momentum from some of those on Capitol Hill. You've got Joni Ernst meeting with Hegseth, and she has shifted her position. Not her vote, but her position.
Well, that's an important distinction to make, Manus, and I'm glad you noted that, because she is directionally not coming out in opposition for Hegseth, but is not yet saying whether she will vote yes. And she also said, look, we're looking forward to a full hearing on his nomination. And we're still waiting to see what the FBI background check would yield. And remember, Hegseth is facing these allegations of sexual misconduct, alcohol abuse, and mismanagement at veterans groups. These are claims that he has denied, but nonetheless, they have put his nomination as Trump's defense pick on knife's edge. He can only afford to lose 3 senators' votes. And if some of those allegations really hold water as the confirmation process moves forward, it will be harder for moderates like Joni Ernst, who is not only a military veteran, but a sexual assault survivor herself, to then say, well, I will actually cast the vote for you. She is committing to seeing the process go through. Hegseth is continuing, as you noted, to fight for this nomination, and he is preparing to meet today with Senator Lisa Murkowski, and then tomorrow with Susan Collins. These are 2 other moderate Republican women senators whose votes will be critical, and they will be part of his ability to hold those three votes that he needs. Right now, though, he has the most important vote of all, and that's a vote of confidence from President-elect Trump. That said, Trump has been looking at possible alternatives, including Florida Governor Ron DeSantis as a possible backup in case Hegseth's nomination does go south.
Yeah, I mean, she is basically saying, Joni Ernst is saying he's committed, Pete has committed to completing the full audit of the Pentagon, and that's necessary for selecting a senior official. So it's about participating in the process. Let's talk about the potential dislocation between Canada and the United States. You've got the Canadian Prime Minister, Justin Trudeau, basically saying he will respond to Trump if he imposes tariffs. And he reflects back to what they did back in 2018. It was effective when they responded then. But we also have a little bit of a backwards and forwards. So there's a bit of a shift, I wouldn't say a tectonic shift from Trudeau, but it's more sort of an assertive moment for Trudeau. And then you've Trump's response.
Trudeau made these comments during an appearance with the Canadian Business Group, and you would expect him to come out and say, look, I am here to defend your interests, and especially given the political troubles he has been facing this year. So his remarks that he will respond in kind if need be if the U.S. does follow through on this threat, are notable, and it signals that their concern remains very active. They do not think that Trump will simply walk away from this threat. And it's notable also that Trump made the threat of 25% tariffs across the board on goods from Canada and from Mexico not as so much an economic tool, but as a way to gain policy concessions that would address his concerns over the border, namely the influx of migrants into the U.S. and the flow of fentanyl and other illegal drugs into the United States. And what he is saying is that neither Canada nor Mexico is doing enough. Trudeau has countered that, including by flying to Mar-a-Lago to meet with Donald Trump at his club and have dinner with him to say that, look, we in Canada in the North, we are doing our part. But at the same time, to this business group, he has to say, look, we are prepared to respond in kind if need be.
Well, we saw them go respond on, what, bourbon, Harley Davidson. Say you're in the market for Harley Davidson. Playing cards, that's more the sort of the spectrum, the cost spectrum for me. And Heinz ketchup, there you go, Shep. That's the risk. Harley Davidson's to Heinz ketchup retaliatory tariffs. Mike Shepard in Washington, thank you very much. A Bloomberg exclusive now. Citi CEO Jane Fraser is halfway through her 5-year plan to turn the bank around. Let's take a listen to the conversation with our very own Sonali Basak.
My ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about, we've got the right strategy and vision, we're executing with the right organization, we've got making sure we've got the right talent and culture in the firm, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
If you could give yourself a grade on the restructuring plan, what would you give yourself?
Oh, we aren't done yet, so I can't give ourselves a grade yet. I've always said that this is a multi-year journey. We're going to be very disciplined about making sure that we don't take shortcuts. And the problem with grading yourself along the way is it becomes too tempting to do a quarter-by-quarter grade, as opposed to we're just very, very focused and accountable for delivering what the end product looks like.
Speaking of the end product, you've set out a goal to bring returns on tangible common equity closer to 11 to 12%.
In the medium term and beyond after.
So Bloomberg consensus this year has Citigroup's return on tangible common equity at 6.8%. What do you say to critics that feel like you're not getting there fast enough?
Oh, we have undertaken a multi-year major transformation of an institution. We are working with ambition, with accountability, and with urgency. So we've already divested all but one of our international consumer franchises and wound down those that we couldn't. We've undertaken a massive reorganization of a company of 240,000 employees in 6 months, such that 50,000 people have a different manager than had 6 months ago. Now, it's been major change. We're being bold. We're ambitious. We're holding ourselves very much to account to deliver on the outcomes we should do. And I say, look at the proof. We're delivering, and we're determined to keep on doing so.
Citi CEO Jane Fraser there, an exclusive conversation with Bloomberg's Sonali Basak. Coming up in the show, I set you up for your trading day. Microsoft's annual shareholder meeting. We'll run you through the slate in just a moment, right here on Bloomberg Brief. Good morning from New York.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Take a look at your day ahead. Microsoft has its annual shareholders meeting, and the NFIB small business optimism data is out at the top of the next hour. GameStop reports their earnings after the bell, and we've had a few earnings in the past overnight session. Oracle extending its post-earnings decline. The revenue was in line, but it just did not make the estimates that the market had out there. So we dropped post-market and pre-market. Norwegian Cruise is raised to a buy over at Goldman Sachs. Price target $35. And on eBay, Jefferies downgrades this stock to underperform on sluggish performance. So that's a note from them. Quick snapshot of equities. The question you need to ask yourself in this equity market is how much, according to Laurie Calvasino, have U.S. equities pre-traded the political tailwinds of 2025? Very similar to the 2017 run-up in stocks. Get ready for a lot of volatility. That seems to be the consensus. Air pockets will appear. That was the view from Seema Shah for next year. Right now, we're flat as she trades. The Bloomberg surveillance team will take you through the next couple of hours on markets. We're counting down to the CPI tomorrow, 0.3%.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Host of geopolitical turmoil.
I think the market is finally waking up to some of the reality that Peter's talking about, that this isn't going to constantly be smooth sailing with an incoming Trump administration. He's already starting to have these conversations about renegotiating trade deals with the likes of Canada, with Mexico, and obviously, of course, what is going on with China. But what's happening with China right now is happening under the Biden administration, which is basically a tit for tat when it comes to the tech industry. Yesterday, going after NVIDIA with this probe in response to an export control from the Biden administration. We're already in this tit for tat. I think the market's waking up to the fact that, you know what, we're going to get a lot more of that next year.
All right, waking up with a 0.6% decline that absolutely changes and shakes all of our expectations. It also came in tandem with an increase in benchmark yields. Some of this could arguably, and you can pick whatever narrative you want and probably find some buyers of the idea. Some of it might have come on the fact that we got a New York Fed November survey of consumer expectations that showed that the share of people saying they expect to be better financially in the next coming year reached the highest level going back to February of 2020, before the pandemic. Peter, how much is this people reassessing how sticky inflation might be, really renewing emphasis on what we might get tomorrow?
You know, I think part of this is, I always look at the University of Michigan, and they do break it down by Republican and Democrat, and you've seen a big spike in what Republicans are thinking. So I think some of this is just market psychology. It takes a while for people who may be lost to say, oh, things might be worse, and everyone who voted, it's like, oh, this is all going to be better. So I think some of these are very sentiment-driven. You know, it does tend to follow the stock market. One thing that's interesting, for all the the hype, the S&P 500 is only up less than 1% in the past 30 days. So you would think, if I close my eyes, oh, what's the S&P 500 done in the last 30 days? Oh, it's got to be up 5 or 6%. Not even 1%. So I think that chance of a pullback's real, and it could be coming.
Well, on top of that report talking about higher inflation, that concern, the respondents are also talking about the fact that they feel like there's also going to be a stronger and better economy. But to your point on the politics, this is what John Authers leads with today. Inflation switcheroo rings out the election year. In America, how your party is doing is how you expect the economy to perform. Republicans and Democrats are trading places.
Either way, the market right now is firming up after its terrible fall yesterday of negative 0.6%. You're seeing a bit of firming up across the board, actually outperformance from the NASDAQ. S&P futures basically flat, range bound, but at least not negative, at least not right now. You're seeing some dollar strength, euro falling just about 0.25%, 105.25. Yields again inflecting upwards. Watch this space, 4.2% ahead of a key set of auctions amid a real vacuum of other data ahead of tomorrow's CPI. We get $58 billion of 3-year notes being auctioned off today.